Yeah.
There's a bit of waffle in these questions.
You Tories are
okay. Is that us? Yep. Order. Good morning and welcome to the committee. You're both very familiar with the committee, but could you introduce yourselves for the shorthand writer, please? Angela, start with yourself.
Angela Knight, I'm the Chief Executive of the British Bankers Association.
I'm Adrian Coles, and I'm Director General of the Building Societies Association.
Okay. Well, as you know, this inquiry is largely on financial stability. So maybe my first question to you is it possible to design a system where payments are made from a failing bank within days or weeks of a failure rather than months or years as at present, and is work going on that? I mean, I notice a representative of the Maya May has suggested plugging the Bank of England into the ATM network in order to provide immediate access to funds up to £35,000 limit if a bank were to fail.
Do you want to go first?
Yes, I think it is possible to design a system, Chairman, whereby payouts can be quicker. The existing financial services compensation scheme has primarily been designed for investment products and not for the deposit protection in terms of a quick payout scenario. And if we look at the various options that are currently in operation in other countries, I think that there is some information and some models which we could probably usefully consider here. We made brief mention to some of those within our submission to the Treasury on reform of the deposit protection scheme, a copy of which we sent to yourself.
Okay, Adrian, maybe if you just take that and add the point that if depositors were to receive immediately their deposits from the FSCS, what implications would this have on depositors' status as creditors? Could creditor status be transferred to the FSCS?
It's clearly possible to design a scheme where depositors get their money back immediately. That's exactly what happens in America with the Federal Deposit Insurance Corporation scheme. They normally aim to get deposits in the hands of the depositors of a failing bank within 24 or 48 hours. So the answer to your first question is absolutely yes. Although it's fair to observe that in the American system, most of the banks that have been saved over the last 10 or so years have been very tiny institutions with deposits of only 10, 20, $50 million, much smaller than the sort of circumstances we're talking about in the UK at the moment. And what tends to happen with a larger institution in the States is that the depositors do become creditors of an institution owned and controlled by FDIC. So again, the answer to your question is yes, this could be arranged if there was the desire to do that in the United Kingdom.
Good. We hope to finish by 10:30, so we are going to ask brief questions and brief answers so we'll get the maximum out of the session. Peter.
In your memorandum, FST 18, you commented on the amount of liquidity made available by the Bank of England and contrasted that with the amount of liquidity made available by the European Central Bank and the Federal Reserve. Yet when asked a specific question, the Governor on the 29th of November, asked by us, he said that the European Central Bank has not increased the amount of liquidity at all since the beginning of August. He said the Federal Reserve has not raised the total amount of liquidity very much. And then he went on to contrast that with the Bank of England. The amount of liquidity that we are extending to the banking system is almost 30% higher. Can you explain that apparent conundrum?
I'll try, if I may, but I think you'll have to redirect most of those questions back to the Governor of the Bank of England. In effect, what we had in the UK was a money market framework which was more constrained than that of the European Central Bank or that operated by the Fed. Thus, for a UK bank accessing liquidity, there were collateral rules which were much tighter, and there was the so-called penal rate, one which was not experienced elsewhere. Thus, at some points, whereas technically liquidity might have been available, it was unattractive to take it because of the costs involved and because of the lack of ability to offer up the broader range of collateral. It's interesting, I think, particularly to note that now, in fact, today, the market operation that's going to be undertaken by the Bank of England actually does adopt the collateral arrangements that we proposed and reduces the penal rate. So it is as we said. I think that perhaps one last thing, if I may briefly say, Chairman, is this. We, the BBA, had discussions with our fellow trade associations, both in Europe and also in the US, because of the differences that were operating, and we too were aware that somehow the statistics at the bottom seemed to imply a different story that we were experiencing. And we asked the question, what did it look like, how did it feel like for you? And the answer that we got from all of them is it looked like their central banks were actually standing behind the industry, ready to provide liquidity as and when it was needed in a broader way, which was more in line with that which the industry was requesting.
Thank you.
Thank you very much, Peter and Mark.
The FSCS, the compensation scheme, is primarily designed not to deal with a failure of a very large firm. How do we define the limits of what it is supposed to deal with and the apparent liabilities that the state presumably bears for firms that are so large that it can't cope with them?
Well, the current arrangements are quite clear. The scheme is designed to deal with a loss of up to about £4 billion, because that is the maximum amount of money that will be available to be paid out to the depositors of a failing bank after the reforms have been agreed earlier this year and implemented on the 1st of April 2008. So anything above £4 billion, the Financial Services Compensation Scheme cannot help with. In fact, the current figure would be about £2.5 billion. How do we define how big an institution we want to save? Beyond that is very much more difficult. I think if you're looking clearly at Northern Rock, that is an institution that is clearly being defined as too big to fail. If you're looking at some of the smaller banks or smaller building societies, the actual dividing line becomes very difficult.
Do you think there's an argument for transparency about where that line lies?
I think there are two issues regarding transparency. First of all, should there be an indication to depositors about the size of the guarantee, £25,000, or as we've got in the UK now, £35,000. And the second issue is, should there be an indication of the size of the fund that is available to support in the event of a bank failure in relation to the size of the bank. And I think that would also be important information for a depositor to know.
Okay. The protection scheme was clearly largely unknown to depositors themselves. Do you think that banks have a clear obligation to display on their products exactly where the guarantee lies and to what extent it is?
Well, I think you can actually express that question rather more widely. Is there a well-known explanation of the various protection that is given by the Financial Services Compensation Scheme to the broad range of individuals who engage in a variety of ways with the financial services industry? And the answer is, whilst it's said, I don't think that there is necessarily, the sort of pulsating clarity which maybe we should be looking at now. And certainly as far as we're concerned, as far as the banks are concerned, we have, not surprisingly, had significant amount of discussions with this and have said to the FSA we want to engage on this point of explanation. I suppose what I would say is that the attention, of course, has been paid on actually prevention, and I think in this instance that is rightly so. We should be looking at prevention. The question is often asked as, did individuals understand that there was some deposit protection or not? Certainly they got the hang of that relatively quickly with the Northern Rock, as we are all well aware.
Awareness is wider now.
Yeah, and still stayed outside. Awareness is now known, and in one respect that is a good thing, because it means that we can play into that awareness with providing knowledge. As I say, we're waiting. We've said to the FSA quite clearly we want to engage on this. We don't just think it's for one part of the industry. We think that there's a broad question that needs to be asked and answered, and that is, how do we actually describe to the individuals what they are, what is protected?
You listed 4 elements of a protection scheme that you felt were required. Do you think the scheme does actually meet those 4 elements of requirement?
I think the key to all this is actually speed of payout, and I think it's the speed of payout that we need to address, and that might require a mixture of scheme rule changes, but also might require some legislative changes to allow earlier intervention with a deposit taker that's got into difficulty.
I think the speed of payout issue is related to the size of the institution. As I said, if you look in America, they pay out within 24 or 48 hours. If you look at the payments that our own financial services compensation scheme has made to depositors of credit unions, typically those payments are being made in 7 to 10 days. So for small institutions, we're meeting almost the standards that are in America. For much larger institutions, it's much more difficult.
Just lastly, do you think co-insurance has no great value because it simply muddies the water and confuses the customer as to what extent of risk they are actually bearing?
I think co-insurance still does have a place. It's the point at which it starts, which I think is worthy of debate. Interestingly, I think it is the Netherlands who's just gone through that discussion, because co-insurance is quite common, and they've just gone through that discussion, and in so doing they lifted their deposit protection scheme to, I think, the equivalent of about 25,000 UK pounds, and then over, in full, and then over that it was co-insurance up to about the level that we are at the moment. So there is a role, but there is the point at which you start.
But it clearly means transparency is all the more critical, so that people clearly understand what they're buying into.
Well, I think this is all part of your earlier question, if I may say, about how do we explain.
The complexity of the co-insurance is a difficult thing. When we had a limit of the pound was 31,700, that was extremely difficult to explain to the depositor.
Michael, thank you.
Mrs. Knight, the banks have been extremely profitable in the last few years, yet you've been hiding behind a scheme that nobody really understands and that isn't really properly funded. The Chancellor's guarantee for Northern Rock depositors wouldn't have been necessary if we'd had a properly funded, upfront scheme with notices in every branch in every bank telling people exactly how quickly they can get their money out.
Well, interestingly, of course, there has just been a full discussion about the whole of the Financial Services Compensation Scheme and the Deposit Protection Scheme undertaken by the FSA with the assistance of consultants, and they came up with the current limits and current arrangements that we've got. I think the reality is that it is certainly possible to be able to use a deposit protection route for certain sizes of institutions that take deposits, but over a certain amount, and if we look again elsewhere around the world, then you are into big issues and bigger issues than a protection scheme can actually properly cater for. In the question of properly funded, one of the things that we do have here in the UK is embedded within the legislation a requirement, an obligation, if you like, on the FSCS to make demands for payments into it when it knows the extent of its liabilities. So it's not as if you have a scheme where you just put some money in and then everybody goes away for 12 months or whatever. There is a requirement, and that is a requirement that has to be fulfilled for the FSCS to make demands of the relevant part of the industry if it requires funds.
But it isn't true to say that the American scheme simply operates for very, very small banks. Continental Illinois, which failed, I think was 14 billion, about half the size of Rock, given it was 17 years ago. So it isn't true to say it's small banks. I mean, your evidence to us says that you want to stick with this post-funding model.
Correct.
Why not put the money up front so everybody can see it's there and have a system they can get that money back within a few days?
Well, putting money up front is not the only way of making sure that you can get your money back in a few days. If there is a requirement on the industry to pay, there is a requirement on the industry to pay. It seems rather difficult to see why one should have some large sum of money just sort of hanging around waiting when actually the issue is not one of is there money to pay out in a difficult circumstances. It's how does one access what rule changes, what legislation changes are required in order for that to come about. And if I may say, one of the main concerns which I think does come out from the document which we supplied to the Treasury Select Committee is this, and that is that we need to be looking with considerable attention at prevention, and that is where we believe that the whole issues lie, is in the preventative side. The deposit protection scheme, as it currently is formulated, 100% to £35,000 quick requirement to pay by the industry. We think that that is a workable model. The question that arises is how does it get from the FSCS to the individual deposit takers, and that's an area which, as I say, rules and legislation may be required.
But what the Governor said was required was a scheme that didn't mean that people had to wait more than a year to get their money out.
Well, that's we entirely agree.
Aren't you dragging your feet on this?
No. We have actually put forward some proposals, as you know. We entirely agree that a scheme that requires a year to pay out is not good enough. As Adrian Coles has just said, where the scheme is currently being used as being with failed credit unions, and the payout is quick, and indeed has been getting quicker. If one is looking at large numbers of individuals, there are systemic issues and there's panic hanging around there as well. I don't think that one should just say there is the responsibility of an independent or quasi-independent scheme to address that situation.
Last week, Mr. Fallon and I were talking to your equivalent American Bankers Association in Washington, and they were very clear that an upfront funded scheme was essential for the confidence of the system in the first place, and secondly, that when a situation arises, when payout has got to be made, that's probably not the best time economically, so you have a fund there that's available. So that was their unequivocal view to us.
Could I add a point? That I think the crucial difference between the British scheme and the American scheme is not the upfront funding. The crucial difference is that the FDIC is backed by the full faith and credit of the US government, and I think that's what gives the confidence to depositors in the United States.
No, but they were very clear on this upfront funding. So
I know that's the difference, but this is another important.
They were very, very clear on that, and they were saying that the fat years, why not get the money in the fat years so that when the lean years come, there isn't any problem getting money out of people. That was the issue. So I just put that as matter of public evidence. Nick?
The Financial Services Authority in their financial risk outlook in January and the Bank of England in the Financial Stability Report in April both gave clear warnings of problems over weakened credit risk assessment and impaired market liquidity. Why didn't the banks listen to those warnings?
Well, I think the banks did.
And what action did they take?
Well, as far as the banks themselves individually are concerned, they did, as I'm informed, take full notice of the points that were made to them and the issues that were raised. Clearly, we have one bank that may have taken a different view, and I know that you have had a discussion with them. I think also, though, the one thing that neither authority, nor indeed the industry wherever it was in the world, expected was the way in which the housing problems of the US unfolded as rapidly they did and as widespread as they did. But nevertheless, I think that one of the comforts that we can take in the UK is that not only do we have a strong banking industry, but they do heed the documents, the consultations, the other things that are issued from our various authorities.
So everything in the garden is rosy, there is no problem. Surely our experience from August onwards is that there's been a serious problem. Warnings weren't heeded.
Well, I don't know why you say that. I mean, quite clearly there is some very difficult market situations taking place, but you can't necessarily cure a market situation that has arisen, nor can you do anything other than handle something well as it arises. Now, we have well-capitalised banks. They are handling the situation as it has arisen. But what you can't expect them to do is suddenly manage to rectify a problem that has arisen in America. What you can expect them to do is look at their credit assessments and look at how they are handling their own affairs. And I think that is something that we have seen.
Could I just offer an observation from the Building Society point of view there? On the day the Financial Risk Outlook was published by the FSA, we sent out a circular to our members strongly advising them to read the FRO. We gave them full details of the relevant pages for building societies, the relevant developments in the mortgage and savings market that would be most important for building societies to read. And our evidence is that building societies read that carefully and were fully expecting a slowdown in the housing market this year. They weren't expecting the close down of the markets in August, but they were expecting a slowdown, and we encouraged them to read the relevant documents.
Could I follow on from that and ask you that if Northern Rock had still been a building society, would it have experienced what it experienced this summer?
If Northern Rock had still been a building society, it would not have been able, by law, to fund itself 75% from the wholesale markets. A building society can fund itself to the maximum of 50% in the wholesale markets under the Building Societies Act 1986. and typically building societies fund themselves 70% retail, 30% wholesale. I think had Northern Rock stayed a building society, it may or may not have been a successful institution, but it wouldn't have come to the sticky end that it appears to have come to in the way that it has.
Mr. Knight, do you think perhaps there's a lesson here to be learnt for the banks in that if they adopted the same requirements that the building societies have, that would actually give greater protection and security and stability?
Well, the Northern Rock had a particular business model, as you know. If you're looking at the banking industry generally, of course, it is much more broader based in what it does in terms of its operation, how it funds itself and its various activities. I think that if you do have any institution of any sort who has a very narrow focus in terms of both its business model and what it does and indeed how it funds itself, then clearly it is far more hostage to fortune than would otherwise be the case. I think one of the issues as well in all this, though, is clearly coming back to your earlier point about the FSA's communications on risk, and that is that the discussion, the challenge that the regulators undertake, challenge process with various institutions in respect of risk and exposure is something that certainly we believe warrants looking at further. I mean, clearly the FSA did have an engagement earlier this year with the Northern Rock in terms of stress testing and risk and so forth. And, of course, it's something that, as far as the industry is concerned, does require clarification because we want to see proper stability in the market and proper stability within the industry.
But, I mean, have you got any ideas of how these warnings, when they're issued by the bank and by the FSA, are taken note of? I mean, you just told the committee that they were, and yet we ended up with the mess that we got ourselves, or the banking industry got itself into in August. But what measures do you think, or what further action do you think that particularly the FSA could be taking to ensure that when they do issue warnings, that action is taken by the banks?
Yeah. I think, if I may say, you're talking about one bank, not banks in general. Banks, there may well be an institution in any walk of life that does not necessarily take the appropriate action at the appropriate time. But in terms of the industry and banks in general, do they act on warnings? The answer is yes. Are they considered? We see that consideration around the various committees that we operate within the BBA. So we are well aware of the sorts of actions and the sorts of issues that are addressed and how the industry in general addresses it. I think also, though, that the question is this, is what is the nature of the follow-up by the various authorities themselves? Because I agree with you, it's one thing to issue some sort of communication and quite another to say, that they've also put in place, the right tools and the right monitoring process to see whether those actions have taken place. And we do wonder whether that is another area which warrants further review.
Andy.
Thank you.
Thank you.
In the press release that you put out on behalf of the BBA on the 5th of December, you're quoted as saying the operation of the tripartite was found wanting when the Northern Rock problem arose. What changes would you like to see to make it work better in the future?
Yeah. And first of all, we do support the tripartite. We think that the problem is much more in execution than in structure. The piece of work that we want to see done, and as far as I'm aware has not been done, and certainly is not yet in the public domain, even if somebody has looked at it, is this. Is if the various authorities had taken action earlier, both regulatory and in respect of the Bank of England, with the Northern Rock, would we have had a more orderly outcome? Because clearly, certainly the perception is that whilst the issues were raised at certain points in the timetable, actions were far more wait and see. No changes, for example, did take place within the money market. There weren't alternative Plan B peers put in place in respect of the Northern Rock. So before we know exactly what sort of changes need to be made to the tripartite, we need to have that piece of work undertaken by our authorities. What would have happened if they'd taken action rather than wait and see? However, clearly there is a question of leadership. within the tripartite. There is also a question of getting the right information reported at the right time. There's also something about the individuals involved. Is it at the right sort of seniority? And I think, lastly, that there's a lot of work being undertaken on financial stability, clearly within the FSA. There's not all that many people on that side within the Bank of England. And as far as financial service in the Treasury is concerned, we would like to see that side strengthened as well.
Could I add one point to
just
that?
Before you do that, Mr. Coles, let me just press Mrs. Knight a second. Is there an implied criticism in what you've just said about the Governor's decision in relation to the provision of liquidity at the very early stages of this problem?
Well, certainly as far as the industry was concerned, they were looking for changes to the money market in July in some degree of urgency. And the question about wider collateral and penal rate had been ongoing with the industry for around 12 months. Now, this isn't an implied criticism. I'm just stating the facts. We don't want to have I don't want to have that terminology used, but there were certainly differences of view of how the money market should operate, and particularly when there were what were referred to as stress conditions.
Mr. Coles, what was your
for me, looking at the Memorandum of Understanding, one of the key issues that's missing from that is which of the tripartite authorities is responsible for communication once a crisis has begun. And if you look at the final paragraphs of the MOU, which is talking about crisis management, neither the Bank, the Treasury or the FSA is responsible for communicating with depositors. And I think that was one of the key weaknesses on September the 13th, September the 14th. It wasn't clear who was actually in charge of making that communication. And secondly, as Hector Sansa said in his evidence to you, some of the terminology that was used was inappropriate for the ordinary man in the street. So who's in charge of communication when you've got a crisis problem where there's a crisis of confidence, which is essentially a communication issue, is a very important improvement that needs to be made to the MOU.
That's right. Philip.
Thank you, Chairman. Can I turn to the issue of off-balance sheet structures and transparency and disclosure? Hector Sands, when he was here last week, said that we need to consider the use of off-balance sheet financing. Could you comment on whether you think there are mechanisms to bring particular types of structures onto banks' balance sheets? Would that be welcomed by the industry, or would that be a problem for the industry?
Well, of course, some are already being brought back onto balance sheet, as you know.
But by default.
But I think the wider question is, we are where we are now. Should one be looking at other changes in the future? Some of the points that we believe warrant further investigation do surround transparency. They surround some of the way in which rating agencies should operate. I don't want to cast them as the devil in all this, but there are some things there. But also some of the accounting standards as well. Now, there are some accounting standard changes which take place in effect from this year, which again give a greater clarity in that area. What we want to do is actually see how those operate, not unpark the issue, but see how those accounting standards operate and take forward with some degree of rapidity the whole question of transparency and whether and what that provides in terms of furthering the right sort of information to the market. There is, dare I say, though, a proper role for confidentiality in everything. It's getting that balance right.
Do you think Basel I is the culprit here in large part by allowing banks to provide liquidity facilities to off-balance sheet vehicles without having to provide any capital adequacy?
Well, I think that it is certainly arguable now that Basel I is not the right tool for the job, but we're up and running with Basel II. And the market does move on, and standards do have to be reviewed frequently to ensure that they keep up with the market. The whole question of looking at liquidity is part of Basel II, and that's the part that is underway at the moment. One of the issues there is you can't just look at these things from one jurisdiction. You can't say, OK, the UK is going to do this because we operate in a global market. And therefore, the Basel II attention in this area, I think, has come rapidly up their agenda. And some of those things which have been stuck, the discussions which have been stuck for some time, are now likely to be unstuck. But I say again, it's got to be looked at, internationally, not just in one jurisdiction.
Could I add, I think Basel II is going to be particularly important because Pillar 3 of Basel II is all about market transparency. It's about institutions giving much more information to the market about the nature and structure of the balance sheet and the liabilities that they have under particular circumstances, and that should aid the transparency issue that you're talking about.
Yeah.
Thank you. Do you think the FSA is equipped to regulate banks properly?
Yes, I do. I do think they're equipped to do that. I certainly think that they need to review how they do it. And it seems to us, the industry, that there has perhaps been very considerable attention paid on capital, and another very considerable attention paid on, for example, the conduct of business rules, but somehow the gap in between has maybe not had the focus that it should have. I appreciate that, it almost seems year by year additional requirements are placed upon the FSA to regulate more or regulate differently, and I think we all understand the difficulty of addressing that scenario. But there is the very real problem now as to how the FSA should be regulating banks. And whether they do necessarily have the right tools and the right people in place. That is where they need to look. We think there's some strengthening that is required, and we'd rather strengthen the existing system than put a new system in place.
Could I just press you on the people aspect? Do you think people within the FSA have enough knowledge of the financial instruments currently being used in markets and by banks, and do they stay? Is there a retention problem at the FSA for people with those skills?
Well, I think the answer to the first question is clearly no, because if you are a practitioner in the market, you see how quickly it's developing. If you're not a practitioner in the market, you don't. And healthy regulation is that interchange from people from the market into the regulator and from the regulator back into the market. I know the FSA is aware of this, and they have been assuring the industry and the wider public that they're paying attention to the quality and calibre of the people that they have. I think the industry does want that to take place as well, though I suppose that we're sometimes guilty of buying out good regulators at the same time. But a flow between regulator and industry regulator is important in this as it is in other areas as well.
I think there is an issue about consistency of regulation. I know one large building society, for example, that's had its relationship with the FSA headed by 5 different people in 4 years. Yeah. That doesn't give the relevant people very much time to understand the nature of the institution which they're supervising. So I'd like to see someone doing a minimum of 2 or 3 years so they properly understand the nature of the business without being subject possibly to regulatory capture.
In a word, Angela, is it a case of first-tier banks getting first-tier regulators and second-tier banks getting second-tier regulators? In a word.
I think you could argue you want first-tier regulators with second-tier institutions, actually, yes. But yes, the point is right.
On you go.
A bit more about transparency and disclosure, following on from what Philip Dunn asked. Adrian, you mentioned in particular the third pillar of Basel II. Do you really think that would be adequate? I mean, given the problems which have been already encountered with an organisation which I think had said it was already operating to Basel II standards?
I think there are 2 issues about transparency. The first is, what is the nature of the bits of paper that are being issued by issuing institutions, and are the people buying those bits of paper well enough informed to understand what they're buying? And I don't think there's scope. I don't think there should be intervention in that area. I think it's up to the people who are buying the paper to employ the experts to properly understand the nature of the financial arrangement that they're buying into. I think the more important question is, when people invest in banks, should they know whether or not those banks have invested in risky bits of paper on the other side of the balance sheet? And Pillar 3 is certainly going to give us much more information on that, although I'm not aware whether Northern Rock has actually made significant Pillar 3 disclosures since it got its IRB waiver at the end of June this year.
Can I just come back on that point? Because you said that the bank should employ the people who are able to look into the investments and to work
when they buy them.
Yeah, that's right. And depending on that, I mean, in a sense, the people who then invest in the banks are dependent on the banks doing that first bit properly. Yeah. Now, one of the things which has emerged through our discussions is that the due diligence is actually not adequate in terms of people looking into what lies behind the commercial paper. So do you think there's a real need for the banking sector to improve its due diligence so that when it discloses what it's invested in, it doesn't just say, we've invested in these, AAA star rated securities, but that they say what's actually bundled up in those securities?
I personally think that would be helpful.
Could you say a bit more than just it would be helpful? Because it means otherwise, we don't know enough about what your thinking is and about what the bank should be doing.
Building societies typically don't invest in these pieces of paper anyway, so I think I'll defer to Angela on that one about what the nature of the investigation that should take place under due diligence is.
No, it's a fair point. I mean, firstly, as far as disclosures generally, IFRS 7 is one of the ones that's coming into force as of now, and that certainly, I think, will probably help on the general disclosures. And there's some others, as I said earlier. I mean, they're all are coming into place over a relatively short period of time. I think it's important to see exactly what clarity they bring. However, I think the point that you made, has there been perhaps too great a reliance on something being called AAA or BBB rather than proper investigation behind? I think the answer to that is probably the case. And certainly Basel II has kind of brought the reliance on external rating agencies more into the fold than I think that was intended. So more needs to be done. We put a list, which I hope we sent to you, of some of the specific issues that we think is important to look at in terms of this whole area of transparency. One is clearer signposting between mortgage-backed securities based on prime assets and securitisation on subprime, for example. Another relates to the sort of actions that conduit programme managers ought to be providing in terms of regular updating, disclosure of information and so on. Is there more things that can be done? The answer is yes. Some of them do get into rather arcane-sounding language, but the question is it going to be more understandable? Does it need to be more understandable? And that is certainly the sorts of recommendations that the banks are making, because that's where they want to get to.
Can I just ask one more quick one, which is about what are your criticisms of the credit ratings agencies?
Well, as far as the credit...
Give us a quick answer. Moving on.
I think they need to monitor their ratings more. I think they need to articulate why they've got to their ratings, and I think there's something about the separation of the provision of ratings from the financing of the agencies that's important as well.
Thank you. Colin and George.
Is it not abundantly clear now that the banks as a whole, collectively, have been totally irresponsible in lending vast amounts of money against worthless bits of paper?
No.
How can you stack that up?
Well, I think that what you're saying is that there are certainly a problem that has arisen, but it's by no means distributed evenly right across the banking industry.
So they all knew exactly what they were lending against, the value of the pieces of paper they were lending against?
As you will know, the exposure is different, and no doubt the knowledge has been different as well, because some of these structured products are far more complicated than others.
So
but I don't think...
Some banks have been able to lend perfectly satisfactorily against asset-backed securities for which they knew the total value of.
I think you'll find that that is entirely correct, and some will have said that they want an exposure where there is a higher return, so a higher risk, and that is also a perfectly reasonable lending criteria for them to have taken. I think that what is important here, though, is not should banks have a mixture of different types of lending, different types of analysis and different types of criteria. Of course they should. Of course they should. It's an assessment of risk, and if there wasn't that assessment of risk, much of the financing of anything from British industry to industry around the world would not take place. What we have here, though, is probably a pretty unique, I sincerely hope it is a unique occurrence, whereby what is in effect a serious problem in two ways of a housing market in one country has, through the spread of risk, found its way around the world, not just here in the UK, but to other financial centres as well.
I think that's overly simplistic. Can I just say, just two quick ones, Chairman? Was Northern Rock a member of the BBA?
Yes.
And did it discharge all its responsibilities to the BBA properly?
Yes, as far as we were concerned, yes. It participated in committees and it took part in discussions around the committee. The responsibilities...
Rather a lot more obligations than that to the BBA.
No, the responsibilities of a member, of the membership relationship with a trade body is, as you rightly say, something of a two-way street in that we are primarily there to assist our members, often in regulatory and tax issues, and lobby on their behalf. And there's a two-way flow of information. But what we would not expect is one of our members to talk to us about their business and commercial decisions. That is for them. We are there for the generic issues, the market issues, the market issues and those things which are common to everybody. The Northern Rock was, after all, regulated by the FSA.
So the announcement in August was a complete surprise to the BBA as well, was it?
The announcement... Sorry, the problem with the money market and the freezing up of the money market, which was the August the 9th...
Well, member.
That was in September. That was...
When did you become aware of the problems of Northern Rock? Same time as all of us? Or?
Yes, the Thursday evening, when the leak occurred about the lender of last resort arrangements, was the first time that we were aware of the situation.
One of your members was in failure.
Correct. We were certainly aware of the concerns in the market, and we'd read the analysts' reports. We'd seen the share price fall, and we'd read the statement that the Northern Rock had made about its own funding issues, which was in June. So, yes, we were aware of the difficulties, but we were not, and we were certainly aware of the effective closure of the market. But we knew for certain at the same time as everybody else did.
Okay, Josh.
Get some common ground between you and my colleague Colin Brady. Your defence of the banking industry is understandable by your position, but would it not be correct to say that some banks acted unwisely and maybe even irresponsibly in terms of these past months?
In which respect?
So, are you sticking to they're always pure as driven snow?
No.
This was something that couldn't be avoided, or are you saying, or are you agreeing that some of them perhaps now wish they hadn't got into certain...
I'm sure they do. I'm sure they do.
Good.
I mean, I don't pretend the industry is perfect. I do think it does a good job. But mistakes can be made, and a lot of it is about a judgment call. And I suspect that there are some people who, as you rightly say, George, wish they had not invested in some of the stuff that they've invested in. Yeah.
I certainly got the impression that some that came before us, some of their lack of exposure was more down to timing. They got in late rather than in at the start, and so their exposure was less. But it wasn't a question they weren't in it. It was too profitable not to be in it.
And it also depends the type of business that you're running. Are you focusing predominantly at investment banking, or are you focusing predominantly at the retail market? So that would also depend upon people's exposures.
Angela, in the October Financial Stability Report, the Bank of England said that the banks should reflect on their business models, and they gave three scenarios. If I could put the scenarios as, one, they should redesign and carry on, redesign the credit structures, carry on as before because it's profitable, and they might regard this as a temporary setback, which I find amusing, or that they should scale down and move back towards a more traditional model of banking. Which one do you think you'd prefer, and which one do you think the banks will move in?
Okay. Well, I certainly can't dictate to any bank what it is that they should do.
Is
but what one can certainly see from their actions, what it is that they are doing, and that is that they are reassessing the credit situation. They are looking at their activities and their business models, and they are, like I think the rest of us, hopeful that this period of uncertainty will come through, and then they'll be able to use their repriced risk and their review of their business model to recover in the activities in which they want to get involved.
So that's the first one. Make these instruments a bit more transparent and carry on as before.
I don't think that just carrying on as before is exactly the description of what I've just said. I think, if I may say, that the assessment of the business model and the business that you want to be in and what you think is going to happen to that business is something that's taking place right now within the industry itself. They're assessing where they have made losses. They're assessing what is the situation with some of these complex products. To decide what the outcome and where and what changes they're going to make, I don't think that AI can tell you, and I doubt that they've all come to that conclusion yet, because at the moment some of the problems of the subprime are still in the process of unfolding. So there has to be an element of wait and see, an element of review, as well as an element of change.
Thank you, George. Jim.
How damaging has all of this been to London's markets?
Well, I think it's been quite damaging, actually. I went out to Brussels probably about middle of September for the first time, and I keep going out there, and we also, because we are an association where 60% of our members are from overseas, get the impressions of the industry and of authorities around the world. And London does rather look like its authorities dropped the ball, that when push came to shove and a problem arose, other countries managed it, and the UK somehow didn't. It's because, I think, so much of it got played out in the public domain, queues outside banks, and immensely visual things. And so I think that we have to recognise that it's done us damage and recognise that we now have got probably quite a lot of work to do to restore that damage.
Who should lead the international action that's required to bring about better standards across jurisdictions?
Yeah. There are a number, as you know, of big international entities, IOSCO being obvious one, World Bank. You know, there's a number of organisations and institutions already there. I think that actually the best way to make those sorts of global institutions work properly is for countries which have big financial centres such as ourselves to fully engage with global standards. You can never be sure that everybody's going to abide by global standards, because in the end it's got to be locally administered. But the big centres are the ones that have the people, they have the products, they have the broad range of services, and they have, of course, the self-interest of getting the global standards right. So that is the sort of engagement which I sincerely hope we continue to make, because I do know the Treasury and the FSA have both been making those sorts of proposals over recent times, and no doubt earlier as well.
Haven't we got on the international level the same slightly chaotic separation of accounting standards, reserving requirements, and actual regulation that, to some degree, you've been saying is reflected in our own national arrangement?
And, of course, it's reflected in Europe as well, even before we get out of the region. First of all, there is an inevitability in the sense that things have built up from different bases. Accounting standards have come up from the accounting profession. Prudential supervision has tended to come up from central banks, financial regulation from various financial regulators and so forth. And so to coordinate them together is, as you rightly say, absolutely essential. I think that we see a greater coordination, though, right now taking place. We know particularly between, for example, the work of Basel and the work of the accounting industry, and that needs to be built upon, coupled with proper consultation with the industry, because the industry knows whether something's going to do the right thing or not do the right thing. There'll always be differences of view, but it's how it works practically that's important. Bringing a recognition of coordination together into the minds of countries, of various authorities, is work which is ongoing. But I suspect that if the Northern Rock has done us any good, it has actually brought that recognition very strongly into play in more than one area, that coordination between authorities is essential, and it's essential locally, it's essential regionally, and it's essential internationally as well.
Thank you.
Okay, just the last question, maybe to Angela. Mention's been made, George said earlier, about the warnings that were sent out from the FSA and the Bank of England. And regarding the Northern Rock business model, No, there were comments in the market about that type of model and about the growth and the fluctuations in the share price. Some would indicate that should have sent a red alert to the FSA. Why were these things not picked up? Was it the mentality of, say, a second-tier financial institution not getting into trouble and all the focus was on the big institutions?
I think there's a number of reasons, and clearly the big institutions are always there in terms of the systemic problem that they can create if they get into difficulties, and the sheer numbers of individuals, of consumers, of retail business that they do. And thus there is an inevitability that they will always be crawled over by regulators of the highest calibre, and I think that that's right. It does seem to us, though, Chairman, that as far as the Northern Rock is concerned, that the regulators maybe only looked at two parts of the business. They didn't look at the business as a whole. That the process whereby the regulators looked at the risk assessments and scenarios that the Northern Rock had been undertaking possibly were not strong enough. This is not that I have any particular additional information, but this is how we see it externally, and that maybe steps that could have been taken when there was a realisation of the impact of their total exposure to the wholesale market, that when that realisation was there, that action was not taken, rather the situation was left to wait and see. And wait and see can bring problems, and that is why we believe that as part of either your inquiry or a further inquiry, it is essential to do some exercises to show what would have been the results if action had been taken earlier by regulators, if perhaps they'd followed through on the general warnings they gave to the market, and if changes had therefore been made in advance of the problems of late August and September.
Okay. Adrian, do you want to add anything?
The only thing I would add to what Angela has said is going back to the question that George Mudie was asking, where will banks go? Is there likely to be a retreat into the more traditional banking model? I think one of the conclusions that building societies have reached over the last 3 months is an absolute vindication of their decision to retain the traditional model that has worked very well for them over the last 100 years or so and will continue to work well for them into the future.
Fine. Well, thank you very much for your efficient evidence. It's very helpful to us, and thanks again.
Nice to see you.
Governor, welcome to the committee with Sir John, and I believe you have an opening statement. Could you first introduce yourselves for the shorthand writer, please?
Thank you, Chairman. On my left is John Gieve, Deputy Governor for Financial Stability. And if I may, Chairman, I'd like to give a short opening statement. As you and the committee will be aware, the problems in the financial sector remain with us. A painful adjustment faces the global banking sector over the next few months as losses are revealed and new capital is raised to repair bank balance sheets. Uncertainty about the possible scale and distribution of losses means that interbank lending rates have risen further relative to expected official interest rates. The behaviour of those spreads has been very similar in the sterling, dollar and euro markets, exacerbating concerns about a credit crunch in the major industrialised countries. That remains the concern not only of the Bank of England, but of all the major central banks. And I will return in a minute to our market operations. But we're also thinking about the changes needed to prevent the crisis that befell Northern Rock from happening in the future. There are, as I said in my speech in Belfast in October, 3 main lessons from the recent turmoil for the UK's framework for managing the financial system. First, the UK authorities are alone in the G7 in being unable to deal with a distressed bank under a special resolution regime. We rely instead on normal corporate insolvency laws. But if a bank enters administration, depositors may have to wait a considerable time to gain access to their funds. Knowing that, they have a strong incentive to join a bank run. So at present, we cannot allow a bank to fail unless it's clearly insolvent. In turn, the expectation that the authorities will try to avoid insolvency puts a floor under the bank's share price, and that prevents the authorities from intervening to implement a reorganisation of the bank. So a special resolution regime is the most important reform now, and it will require legislation. Second, experience in other G7 countries suggests that a new regime should be supported by credible deposit insurance arrangements. A model for deposit insurance that draws on international experience would have permanent 100% coverage up to a limit, with transparent and widely understood prompt payout commitments. And third, the experience of Northern Rock demonstrates the importance of regulating the liquidity position of banks. Northern Rock believed that its adoption of Basel II meant that it would have surplus regulatory capital, and in July it proposed to increase its interim dividend for 2007 by 30%. But its liquidity position remained extremely vulnerable to the type of shock that occurred on the 9th of August. It's clear that regulation of capital alone is insufficient. Tomorrow, the FSA will publish a discussion paper on liquidity regulation, and the bank fully supports this initiative. Much has been said about the operations undertaken by central banks in the money markets during the recent turmoil. All central banks have the same primary objective in this area: to implement monetary policy by keeping interest rates on overnight borrowing in the money market in line with the interest rates set by the MPC. After a short period of volatility in August, we have achieved that objective, and the gap between overnight interest rates and bank rate in the United Kingdom has on average been the same as in the euro area and smaller than in the United States. I'll pass over a description of our money market operations, but leave it in the text for the record. Last week, central banks around the world announced a coordinated set of actions in response to increased pressures in short-term interbank lending markets. The bank has raised the amount on offer and widened the range of high-quality collateral eligible in its regular 3-month lending operations that had already been scheduled for both today and for the 15th of January. Our lending in other operations will be correspondingly reduced. The actions announced last week demonstrate that central banks are working together to try to forestall any prospective sharp tightening of credit conditions that might lead to a downturn in the world economy. A key lesson that central banks around the world have taken from the recent turmoil is that in stressed conditions, any bank that is seen to come to the central bank to borrow, whether in regular standing facilities against high-quality collateral or against wider collateral in a discount window or support operation, can become stigmatised in the market. It's important that in future banks have a means of accessing the central bank when necessary. So over the next year, and in consultation with the banks, the other tripartite authorities and other central banks, we will be reviewing this element of our money market operations, and in due course we shall publish a revised Red Book that describes our operations in the sterling money markets. Chairman, I'm grateful for the opportunity to make that statement this morning, and John and I stand ready to answer your questions.
Fine. Thank you very much, Governor. Regarding last week's actions by the central banks, the markets appear to have taken the recent joint action not as a sign of strength, but as a sign of things being worse than people thought. How would you respond to that suggestion?
I don't think I would fully share that view. There was always a risk that any intervention by a central bank is interpreted as a sign that the central bank has seen something that others haven't. But I think the fact that this was an international coordinated action, which we at the bank were extremely keen on making international, did achieve two objectives. One was to demonstrate that the central banks were working together, and perhaps that hadn't been as evident as it might have been since August. And secondly, it was a clear recognition that all the central banks were saying to the market, yes, we do understand the deterioration in sentiment in credit markets, which have been very evident over the previous 4 weeks. And we are conscious of the concerns that you have, and we are determined to take whatever set of policy actions is necessary to ensure that we do not see a serious downturn in the world economy.
There is a view held by some that this is not just a crisis of liquidity, but of solvency, and as a result, the concerted actions of the central banks may not help.
Well, it's certainly true that the reason for the rise in spreads in interbank markets in the past month is not due to a shortage of cash. That was the case in August and September, when the banks were trying to accumulate as many liquid assets as possible, and the rise in the interbank spreads in that period did represent an attempt to accumulate liquidity. But the large banks are now awash with cash. The issue is not whether they have enough cash, the issue is whether they're willing to lend. And in recent weeks, and this was the reason for the coordinated action and the concern shared by all central banks, what has become evident is that banks are concerned about the capital position of other banks. They do not know where the losses resulting from the array of derivative financial instruments will finally come to rest. And I think in the last 4 weeks, we've also seen a more disturbing development, which is that the banks themselves are worried that the impact of their reluctance to lend collectively will lead to a sharper downturn in the United States and perhaps elsewhere, thus generating further losses outside the housing and financial sector, which will feed back onto bank balance sheets and reinforce their reluctance to lend because of the need to generate more capital. That concern is a serious one because it does hold out the prospect that if banks behave in that way, then there will be a self-reinforcing downturn in credit and activity. That is not necessary by any means, and provided we can help to dispel that sense of fear, and that was one of the reasons for the actions last week, demonstration that the central banks are clearly aware of these concerns and problems, and we will take the appropriate actions to respond to it. If we can dispel that sense of fear, then in fact we'll be back again in a position where I think after the end year, banks will gradually realise that once all the losses have been revealed, and once they have taken steps to rebuild the capital of their balance sheets, which several very big banks have already done, then conditions will return to a more sustainable position.
Mm-hmm. Right. It has been suggested that your own position, Governor, is characterised by a U-turn. In the summer, you were saying that if you were lending to banks with a penalty rate, and there were certain conditions in the collateral you were accepting. Now there isn't a penalty rate, and you've widened the collateral which you will accept. And you also mentioned in Radio 4 and other areas that you weren't here to bail out banks, that it's not the role of the Bank of England is not to do what the banks ask us to do. People would suggest now that what you have done is the opposite of what you said you weren't going to do in August. And as a result, you've done a perfect U-turn.
Well, it's not my view of what I've done. What we did in September when offering a term tender was to say we are willing, given the concern about the British banking system, to offer money at a very wide spectrum of collateral, including raw mortgages. And if we were going to lend against that kind of collateral, which European Central Bank, for example, would not lend against that kind of collateral, then we felt it appropriate to put in place a penalty rate which was fixed ex ante, so that any money would be lent at the clear penalty rate. What we're doing now in the coordinated action is to lend against a narrower range of collateral, only marketable instruments. The money will be auctioned off, and in that process I fully expect that the rate which people who get the money will have to pay for it will turn out to constitute a significant premium over bank rate. So in that sense there is a penalty rate built in through the auction process itself.
Why do you think you have been so widely understood then?
Misunderstood,
misunderstood, yeah.
I wish I had been widely understood, Chairman. Well, I think
some would do.
There are two reasons for that, I think. One is that I failed to speak out in August to explain how money market operations worked. I wish I had done. And by the time it became possible to do so in September, we were right in the throes of the problems with Northern Rock, and it was an extremely difficult environment against which to explain the arcane details of money market operations. The second reason is that very few people, in fact, do understand money market operations. Even now, I find it very hard. I make big efforts to see people to explain it to them. Very few people seem to understand the basic point that in order to keep interest rates in the market, overnight interest rates, in line with the policy rates set by the Monetary Policy Committee in our case, Governing Council in the case of the ECB, to implement monetary policy, once the beginning of a month has started, the amount of liquidity which can be injected into the system is completely fixed. If you try to inject any more than the banks are told to hold as their reserve targets, or in our case, choose to hold as reserves, then if you inject more than that, the banks will have more reserves than they need to hold, will try and lend it out, and that will push the overnight rate down. If you don't inject enough, then people will be scrabbling around to get liquidity. That will bid the interest rate up. So whatever liquidity is injected, and often it attracts great headlines, in fact, what central banks then do is to offset that. What they give in one hand, they take away with another within the same maintenance period. Not the same day, or even necessarily the same week, but within the same maintenance period they have to do it. And that's why I've been trying to explain to people that since the beginning of August, the European Central Bank has, in net terms, injected hardly any extra liquidity at all. The Federal Reserve, 4 or 5%, I think, and the Bank of England, 37% more. Why is that? It's because we allow our own banks to set their own reserve targets. And if they choose to hold more reserves, they can do so, and we supply the increased amount correspondingly.
Okay, you mentioned that you failed to speak out. In our inquiry, we are looking at the issue of communication strategy of the tripartite arrangement. Would you consider that's an important area for us to focus on?
Yes, it is, and particularly in the case where there is a problem of a failing bank. I would say, though, that one of the problems that the tripartite arrangements faced in September was that although the processes for making recommendations on the lender of last resort operation and the decision by the Chancellor worked extremely smoothly, in my view, we were, even on the Thursday, the day before the facility was offered, we were still hoping that it would be made on Monday. That was the plan. And it was only during the course of the Thursday, when rumours started to spread in the market, that it was felt necessary to accelerate that to the Friday morning. And that put a lot of pressure on the communication strategy. But clearly we need to think further about that.
Okay. On the deposit protection scheme, you have mentioned in your public statements that it is inadequate. How long have you held that view, and have you communicated, or did you communicate that view to the Treasury in the past?
Well, I think all the tripartite authorities have been aware of this and thinking about it. There have been a number of... One of the things which Callum McCarthy and I initiated when we both started at around the same time was to pursue regular crisis management exercises. And out of those exercises in 2005, 2006 came the very clear understanding that we had no adequate tools for dealing with a failing bank. And the Treasury completely agreed with that, and indeed work was going on in the Treasury to think about how best to handle that right during the way through 2007. So these issues, I think, were understood, and I say the Treasury was working on it, but I don't think that when we had the exercise in 2006 that afterwards I said, I didn't say to the Chancellor, I have great crystal ball here, and I can see that in 18 months' time Northern Rock is going to get into trouble. Therefore, we better rush this legislation through in the next few months. This was not something, I think, that we felt had to be done overnight. This was something that needed careful thought and attention.
But did you advise or provide information to the Treasury that if, say, when the emergency money facility was announced to Northern Rock, that there would be a risk of a run, given your views on the deposit protection scheme?
Well, I'll ask Sir John, because most of the discussions of that took place at the deputies level. What I will say is I don't think that on the Thursday, when we suddenly had to advance the date of the operation, that we thought that a run was inevitable. The nature of a bank run is that it's a knife edge. It might happen, it might not. That's exactly why the bank run is so difficult to handle.
Yeah, but you've described the reaction of customers as being rational.
Once
you
the
think
run
it's
had
rational?
Once the run had started, once other people had started to run, then it was indeed rational, given the system we had, to join the bank run. But it wasn't necessarily rational to be the first person in the queue, because if other people had not gone and started the run, then it might have been perfectly acceptable for it not to have happened. I don't think there was any inevitability in that.
The reason I'm asking that, Governor, is that you consider the deposit protection scheme inadequate. You know that it's not 100% guaranteed. So you know that when people find this out, and it wasn't evident to everyone, but when they find it out, they say, goodness, I'm only going to get 90% of the money I put in.
Absolutely.
Surely somebody must have thought on that. In that period.
Indeed, but I don't think that doesn't mean to say that it was inevitable that a bank run occurred. But let me ask John to talk about the deputies' discussions.
Well, when we were planning the lender of last resort support, we knew that it might not work, and if it didn't, there would then be a choice between either, in a sense, guaranteeing all the deposits of the bank, or alternatively allowing Northern Rock to go into administration. But we took the view that it was worth trying a classic lending operation first, because that offered the chance that Northern Rock would be able to get through the liquidity difficulties in the short run and then resume normal operations after that.
Can I just add that, one of the ways we'd hoped to deal with this was by having a covert operation. Now, that might or might not have worked, but that was the reason we were arguing for a covert operation. Yeah. And that was ruled out only on the Tuesday, 2 days before the Thursday.
So, John, you say that you're aware it might not work. We've got these missing 4 days, or these 4 days of inaction. Surely there had to be a bit of forward thinking in that.
Sorry, which 4 days are those?
Well, that's from the Thursday to the Monday, when the emergency, when the Chancellor guaranteed everything. So you're sitting down thinking, well, this thing might not work because people are only get 90% of their guarantee. Why wasn't that done straight away?
We did realise that offering a limited collateralised facility wasn't guaranteed to save Northern Rock. We hoped that it would restore confidence, and I think that was a reasonable judgment at the time, and other people commenting on it at the time thought so too. But I think we didn't do enough to reassure the retail depositors, and that became clear on the Friday. I think the deposit protection scheme was one element in that, but one feature of Northern Rock was that it had a large number of very big depositors who had deposits well above the 35,000, and those are always more slippery, if you like. They tend to move on the basis of relatively small changes in interest rates, and so even taking the measures we've subsequently taken on deposit insurance to make it 100% up to 35,000 would not have helped them.
Okay. Governor, you mentioned about the deficiencies in the system and the concerns you had for a number of years. Have you or had you written to the Chancellor with your prescription for the way forward?
We had, after the principals crisis management exercises, the note for record of that, and the Standing Committee deputies that followed it made it clear that all three tripartite authorities felt that an urgent work programme on how to resolve the problems of a failing bank was necessary. and that work was carried out in the
But
Treasury.
did you as Governor write to the Chancellor?
I didn't write to the Chancellor because there was no need. It was in the minute agreed by all three tripartite authorities.
Yeah, but if you felt it was of so pressing need with 4 pieces of legislation required and the system not going to work,
well, as I said,
would it not have been wise to have written to the Chancellor and put your prescription for the way forward on record?
Well, we didn't want to force a prescription at a point when all three authorities agreed that measures needed to be taken to find a mechanism for resolving a failing bank and to improve deposit insurance. And that was something which it was agreed the Treasury would work on. And there was no dispute about that.
Mm-hmm. Okay, good. Okay, well, we'll follow that up. Governor, the issue of nationalisation has been mentioned, whether we talk about nationalisation or public administration or whatever. I had the opportunity to speak to the FDIC last week in Washington. And as a result of that, I would ask you, what would your preferred process of nationalisation be if it took place? Would it be a long-term public sector commitment or something similar to what the FDIC has with the Bridge Bank Authority? Where if it took place under the FDIC, Northern Rock would be immediately passed to the private sector managers to run it, not by FDIC, but private sector managers, so that it's prepared for sale. Can you envisage a system like this in the United Kingdom?
I certainly can, but I think it would require legislation to achieve it. That's the first point that I made. I mean, if we were to get to nationalisation, and I stress if, then I think it would be better if it could be used as a means of breaking the logjam and going to an arrangement which would pass very quickly to a new management team and ultimately to a new ownership team. I don't see anyone as attracted by the idea of having, on an indefinite basis, the banking.
But you could have a system whereby you've identified a management team and you pass the necessary legislation in the House of Commons to effect that change quickly.
You could indeed.
And would that be a system, you think, which is worthy of consideration?
Well, it's not a permanent system I'd recommend, because I think it is much better to have an equivalent of the FDIC with that ability to intervene early. This is now very late in the day. The right system to have had would have been one which would have intervened in the case of Northern Rock well before the 9th of August.
Yeah, but given our committee is looking at this issue, this is an issue which should be on the agenda, you think, in future?
Well, as I said, I do think that legislation to give the authorities the power to intervene early in the case of a failing bank is very important. Banks are not like other companies.
Mm-hmm. So it should be on the agenda. Now, the government has said that it will wait for a report before finalising any proposals legislative for handling banks in distress. We hope to produce that in mid to the end of January. Do you think the government's correct to wait for that?
Yes, absolutely. I mean, indeed, even that's rather a quick timetable. What matters is that we get the proposals right and get the details sorted out. Good. And as I said to you when I came in September, I very much hope that the Treasury Committee would take the lead in all this because, in my view, this is something which deserves bipartisan, tripartisan support. Mm-hmm. This is not a party political issue. This is an issue in which, as I said, we are the only G7 country that doesn't have the power to deal with a failing bank in this way.
Okay, well, we're hoping to get that out by mid-January.
Good.
Michael.
Governor, just to be absolutely clear, it was a result of the stress tests in 2005 that it was minuted that the improved legislative framework needed was now urgent.
2005 with the deputies' meetings and crisis management exercises. The principals first had, that's Callum McCarthy, a minister, and myself, first got involved in a crisis management exercise in 2006. And at the end of that exercise, Callum McCarthy, myself, Ed Balls as a government minister, Treasury officials, all agreed that a key part of the future work programme was to work on these issues, and that indeed was put in place.
And what was the date of that?
That was late in 2006.
So that was a year ago?
Now, yes.
Yeah.
But work indeed on this was going on in the Treasury at the point when Northern Rock got into trouble, and it seemed to me perfectly reasonable. I did not say to anyone, you have to do this by the end of July, because otherwise we won't better deal with Northern Rock. No one anticipated that. But the work was going on.
No, but it was identified as urgently needed a year ago.
Well, it was important, yes.
You said urgent in answering the chairman.
Yes, but that requires designing and thinking about legislation, and that is not a simple, straightforward matter.
So the Treasury hasn't been dragging its feet on it?
I don't believe it's been dragging its feet, no. I think, I could perfectly well have written in June and said, look, what's going on with this? And we asked about it. But I think this is a matter where it was important to persuade people, including you, to look at the experience of other countries and recognise that maybe this is one case where we can learn something from the rest of the world. But to win opinion over and to get new legislation through is not an easy or quick matter, and it may not be sensible to rush it. There didn't seem at the time any obvious reason for this to be urgent in 2007 as opposed to 2008.
But it remains the position now, without this legislation, that any one of the big 10 retail banks which ran into similar trouble to Northern Rock, the Treasury would have to do exactly the same, guarantee all the deposits all over again, and if necessary underwrite a lender of last resort facility.
Well,
that could happen at the moment.
I very much hope we won't get into that position. But the reason and the need for new legislation, and the reason I'm stressing it now, is that we don't have a means of dealing with this absent new legislation.
Okay. The Sunday Times reported a senior bank official as saying that the Prime Minister and Chancellor were, and I quote, unable to focus because morale throughout the government is so low. Were you that senior bank official?
I can assure you they are not my words, and I do not share those views at all. I have meetings from time to time with senior economic commentators, and one of those was indeed with Mr. Stelzer. But the discussion was about economics. I explained to him how our money market operations worked. I'm always trying to find people who don't understand how it works and point out to them how it does. And I explained to him the 3 points in my October speech, which, again, I mentioned this morning. But the conversation was about economics, not about politics. None of that comment in the article I recognise at all, and they're certainly not either my views or my words.
But is it the case, do you think, that the government can now move quickly enough?
Yes, but as I said, it's important to get it right. I think that's why it's sensible to wait for your report, for the Chancellor to have time to see the recommendations from the bank and from the Financial Services Authority. Then it would probably be sensible to have a period in which people can discuss and debate the proposals, and then you in Parliament will then have the responsibility of taking through this legislation. That's not a quick process either.
No, I understand that. But if this was a need identified a year ago, it might seem to our constituents this is all taking rather a long time, and we are very, very exposed to another Northern Rock.
Well, that's why I think it is important now to move quickly, but not so quickly that we get the detail wrong. I think at the end of 2006, I certainly did not anticipate that it was likely that we would be faced with this problem during 2007. And I quite readily accept responsibility for that. I did not say you have to do it by the middle of 2007. I said it is important that we work on this and not let it just stand on the shelves gathering dust, but work on it. And we made that point, and that was agreed by all the participants in the tripartite meeting in 2006.
But the minutes said it was urgent.
Yes, but urgent does not mean rushing it in such a way that you get it wrong.
Thank you.
Graham.
Thank you. First of all, can I just return to something Sir John said a little earlier? I think in relation to the lender of last resort facility, you said we knew it might not work, and we had a choice between guaranteeing, and if it didn't work, we had a choice between guaranteeing all the deposits or allowing Northern Rock to go into insolvency. Who made that choice?
Well, ultimately, the Chancellor made the choice to offer the guarantee to depositors.
But at the I think your comments referred to the time before the facility had been granted, and the choice. You were saying that we knew in advance that if it didn't work, we would have this choice to make.
Yes, I mean, I think all three parties agreed that that the next move was for the bank to offer a facility to Northern Rock to see if it could tide it through these liquidity difficulties. There was no dispute on that.
But this question of whether to give the 100% guarantee to depositors had been considered before the lender of last resort facility was granted, and a decision had been taken not to do it at the same time as the facility was granted.
Well, the form of the guarantee I don't think had been discussed, but the idea that, I mean, we were offering a secured lending facility, and if that didn't work, then the question was, well, would we continue to offer however much money it needed or not? And we knew that that would require government guarantee. That wasn't something the bank could do off its own balance sheet. So in that sense, we knew there was a further choice beyond the secured facility on whether to just provide whatever funds were needed or to let the bank go into administration. But we thought it was worth, as the first step, seeing and having a go at helping Northern Rock through its problems.
Sorry, just to be very clear, specifically on the guarantee to retail depositors, that was something, therefore, that had been considered before the facility was granted, and a decision was taken not to extend that guarantee at that time.
We decided not to make an explicit guarantee that all depositors would get their money come what may. And that, at the time, I still think that was a reasonable judgment, but in retrospect, of course, we didn't reassure the depositors because we didn't offer that guarantee on the Friday, so we had to offer it on the Monday.
And who made that decision at the time? Was it at the time that it...
On Thursday or on...
Previously, at the time that you decided not to extend the 100% guarantee to retail depositors at the same time as...
The decision to offer a secured facility, for us to offer a secured facility, was the bank's decision authorised by the Chancellor. The decision not to go further than that was a tripartite decision in which I think all three parties were at one on that.
Thank you. Just if I move on and ask you, Governor, when you gave evidence to us in September, you told us very clearly that as a result of the Market Abuses Directive in 2005, we were unable to carry out a covert lender of last resort operation in the way that we would have done in the 1990s. It's been reported since that the European Commission doesn't agree with that view. Is that because the text of the directive is different from the UK legislation that enacts it, or is it a matter of differing opinions on the same text?
Well, there are certainly differing opinions in the legal world on that, so I can tell you. The final resolution of whether there could or could not be a covert operation was reached on the Tuesday before the facility was given. It was a decision by FSA, supported by the tripartite legal advice, on two grounds. One, under the listing requirement, which FSA is responsible for, and Northern Rock's obligations as a listed company, and secondly, under the Market Abuse Directive. And we were advised by FSA that under both it would require Northern Rock, not the bank, but Northern Rock had to make a public statement of the fact that it had the facility. Now, I should say that Northern Rock were very keen to make a public statement that they had the facility, because their view was that they didn't want a covert operation. They wanted it to be overt because they believed that the sign of reassurance of having a facility from the Bank of England would help them, and in fact that's what would prevent a retail run in their view. Well, obviously, sadly, that didn't turn out to be the case. But the legal advice was clear. Now, I gather now that at least on the Market Abuse Directive, there is still a difference of view between some interpretations in the UK and some in Brussels, but also some differences of interpretation between the original advice we had and the current advice that is being received. Somehow this still needs to be resolved, but frankly it's not the most important issue, because I think the Chancellor was absolutely right in saying that the facility of the size required would almost certainly become public knowledge. So it was not really an issue worth pursuing. But that's an issue to be resolved still on the table. And I think that my conversations with central bankers from around the world, they are very conscious of this case, and they recognise that irrespective of what the law says, in practice now, it may be extremely difficult for lender of last resort operations to be conducted in the covert way that they were even in the early 1990s, where what happened still not being revealed. And I think that is a challenge to thinking about how central banks intervene, which all of us will want to think carefully about.
And the legal advice on the Market Abuses Directive, I think you said that came from the FSA.
Yes, it came to us from, it was the FSA advice, but it was taken by the lawyers involved in the tripartite arrangements, or lawyers from all three bodies.
And would you be willing to share that advice with the committee?
I would have to take advice as to whether the lawyers would allow us to do that. I mean, this is something which often this advice is given as a matter of legal privilege. I think I need to consult on that. I personally don't feel strongly about it, but I think I do need to take advice on that.
Okay, thanks. I think that's a wise answer, Governor. And the other one.
Governor, is it inevitable that Northern Rock will be nationalised?
Well, I don't know. I don't think anything is inevitable. I think it's still possible that it may be certainly into January. We don't know what the state of the financial market conditions will be. I don't think you can rule out the possibility that a management team will be able to obtain a degree of financing that would enable it to become the preferred bidder and for that to lead to a successful bid. I wouldn't want to speculate on what will happen. It's very difficult to do so.
But we're told that they need to raise around £15 billion, mainly to pay back part of that that's been loaned by the Bank of England. Is there any possibility that they can do that in the timescale, especially since quite a lot of the shareholders, hedge funds in particular, seem to be briefing against them?
Well, I'd say two aspects to that. The first one is that, of course, part of the original bids did include their proposal from the bidders to raise money and pay back at least the initial Bank of England lender of last resort facility. That's become more difficult in the last couple of weeks because of the deterioration in sentiment in financial markets. But if that were to improve in the new year, that may come back onto the table again. The second thing I'd say is that the difficulty of reaching a reorganisation of Northern Rock, which is absolutely desperately needed, is made much more difficult by the fact that the shareholders can block what seems to be a sensible discussion of reorganisation by the people who are financing the vast bulk of the balance sheet. And it's precisely that problem to which the idea of early, prompt corrective action and having an agency that can intervene in a failing bank before it reaches the stage of insolvency is, in my view, so important. And it's why all the other G7 countries have introduced a mechanism like that. And the FDIC is perhaps the best example of that.
Do you believe there's a need, turning now to the tripartite arrangement, do you think there's a need for drastic surgery to the tripartite agreement?
No, I don't think there's a need for drastic surgery. I think that the bits of it that were described explicitly in the Memorandum of Understanding, which set out the responsibilities of the three partners, actually worked pretty well. But what didn't work so well was that there were issues that came up that weren't described in the Memorandum of Understanding. And the most important ones, to me, are the absence of sufficient instruments available to the authorities to deal with a failing bank. That's why I put so much weight on the importance of the 3 points I made to you at the beginning this morning. I think if we had the power to intervene early, or somebody had the power to intervene early, and there had been a different deposit insurance system, then I don't think the problems at Northern Rock would have led to the outcome that resulted.
Would you accept the criticisms about lack of coordination between the tripartite partners? And if so, what changes do you think are necessary to improve coordinating?
Well, I think the cooperation worked well. I mean, it's clear that the shock of seeing Northern Rock get into such difficulty and the impact which the television pictures of depositors on the streets had really made a big impact on people. But I don't think in and of itself that means that the coordination of the tripartite authorities did not work. As I said, when it occurred, we simply didn't have the instruments to deal effectively with it.
I was intrigued by your statement. You include knowledge of a discussion paper on liquidity regulation being produced by the FSA. I wondered whether you would care to comment. I'm assuming that you've been consulted in relation to this, as whether it addresses issues of coordination between the tripartite partners.
Yes, it does, because it makes very clear that whatever regulation FSA adopts in an improved sense to regulate liquidity, it will want to cooperate and work with the Bank of England, because the way we conduct our money market operations will clearly have implications for the way they choose to measure liquidity and decide how to regulate it. But there's a very important point that was made by Professor Charles Goodhart in an article he wrote on liquidity a month or so ago, where he said there is no single number in measuring liquidity that will tell you the true story. It's no good just looking at the amount of liquidity you've got for the next 2 weeks or the next 4 weeks. You need to look at a range of numbers and apply qualitative judgment as to whether or not the institution has adequate liquidity. Now, I do think it's important that this be taken much more seriously because, as I said, the Northern Rock is an extraordinary example Here was a bank that adopted the Basel II method of capital regulation, and as a result found that it had one of the highest capital ratios of any bank in the UK, proposed to return that to shareholders, and yet it was in a very vulnerable liquidity position. That shows, if anything does, that capital is not all. Now, that's not a criticism of Basel II. Basel II is designed only to look at capital. But it does mean that in parallel with it, you do need a proper regime of regulation of liquidity. And the discussion paper that FSA will publish tomorrow is the first step on the process of making sure we get one.
There have been suggestions, indeed comments made, that perhaps the way to address the tripartite arrangement is to create a new body that would come into play exactly in the circumstances that happened in relation to Northern Rock. Would you have any sympathy for that type of reordering of the way in which the arrangements operate?
Well, what I think is most important is that we actually create the powers for some authority to intervene preemptively in a failing bank, akin to the FDIC. Now, where that is located, I do not have strong views on, and that's something that can be discussed. What's most important is that someone's got it and can exercise it.
And you're not minded to suggest that that should be with the Bank of England?
No, because the one principle that I have pursued absolutely to the limit while I've been governor is that we've never fought any turf battles. And I would much rather give up any pretence that we should be involved in this than for the UK not to have these powers available to some authority. It is not my objective to try to acquire or accumulate powers in the bank. It is my only objective to make sure that the UK has a system of resolving failing banks that works, and we don't have one at present.
So you're going to leave it to the Treasury Select Committee to make a recommendation?
I think the Treasury Select Committee were an admirable group of people to recommend where that power should reside.
You're going too far, Governor. George.
Does that include me, Governor?
Absolutely.
Governor, I'd like to follow up on a question Mr. Fallon put to you in terms of this leak that was very embarrassing for the Chancellor, the Prime Minister and yourself. Now, I accept that you had nothing to do with it, but the Sunday Times did say it was a senior Bank of England official. Now, I would be interested to know what you've done since the Sunday Times came out. Have you had your senior people in? Have you checked diaries? Have you asked which ones put you in this embarrassing position a few days before this hearing?
I don't believe that anybody in the bank would make comments of that kind. I know my colleagues well, and I wouldn't dream of saying, who had lunch with whom when. That is not the kind of comment that anyone in the bank makes.
Do you think it's a type of reporting that the Sunday Times gets up to, using a source in the Bank of a senior source in the Bank of England?
I do not believe for a minute that those words in quotes corresponded to anything that a Bank of England official actually said.
So the Sunday Times were just bolstering their story by the lazy use of a Bank of England senior source?
Well, you might think that. I couldn't possibly comment. I have learnt over the years not to believe a lot of what is in the newspaper.
Now, the press are after the Chancellor, and yesterday's Financial Times made 3 assertions about the financial rock, and I'd like to go through them with you. One of them I raised with you the last time, but I'd be specific. Was there a rescue bid from Lloyd's TSB on the table the weekend before the run? That's the first part of that question. And was it specifically put to the Chancellor as either advisable or acceptable, and did he reject that advice if given?
There was no firm bid on the table at all. There was one pretty vague telephone call which came to bank officials and then passed to me, originating in FSA, saying that there might be a bidder, but they wanted to know first, before putting a bid on the table, whether it would be possible for them to borrow about £30 billion without a penalty rate for 2 years. And I said, well, the Bank of England does not normally lend £30 billion to a going concern. In any event, our balance sheet is not big enough for us to make that kind of decision. And it was absolutely clear that it was, however way you looked at it, it was clearly state aid, because it was for a takeover bid to pay a positive share price to another company. So it was clearly state aid. So I said to the Chancellor that this was not something which the Bank of England would do. My advice clearly was that this was not an operation which either central banks or governments normally did. If it were to go ahead, it would require an indemnity from the Bank of England. Our advice, legal advice, was that this was clearly state aid, and this was perhaps most important of all, that it would be quite impossible to make an offer of a loan of that kind to one bank to buy Northern Rock without making it quite clear to other potential bidders that they too would have access to it. And I think, as the Chancellor said when he came to you before, the idea that if he stood up and said, you know, I am willing to lend £30 billion to any bank that will take over Northern Rock, that's not the kind of statement that would have helped Northern Rock one jot or tittle. It would have been a disaster for Northern Rock to have said that. So I don't think it was ever a practical proposition. But in any event, no formal bid was tabled as far as we were concerned.
Okay. Now, Mr. Brady pressed you on this, and I'd like to come back to it. Did the Chancellor get specific Bank of England advice to give the retail depositors a guarantee, or a guarantee at the same time as the announcement of lender of last resort? Now,
No. I said that before, but no, he did
Absolutely
not.
not.
Absolutely not. There was no discussion, in fact, among the principals until the Sunday. And on the Saturday, I spoke with the Permanent Secretary at the Treasury, and I met the Chancellor in person on the Sunday morning, and that's when I made my clear advice, as he pointed out to you when he gave evidence to you earlier this year.
So just let's be clear, which day did the lender of last resort leak out and become public?
It leaked out late on the Thursday. Rumours in the market started on the Thursday afternoon, which led to a meeting at 4 o'clock of the Standing Committee of Deputies. And at that meeting it was decided that because of the concern about leaks in the market, not the television leak later on, but rumours in the markets, that the facility should be announced at 7 o'clock the next morning. That's when the decision was taken on Thursday afternoon.
So,
and then there were television reports later that evening.
Against that timetable, you did not give advice to the Chancellor that when he made that announcement, he should also announce the guarantee for the retail depositors?
No, we did not.
Okay. The third thing was that the Chancellor was advised to use the full leverage of the bank facility to push the shareholders and management to accept an immediate private sale. Now, did the bank give advice to the Chancellor to use that leverage at that sensitive time, or, to your knowledge, did the FSA give the advice?
Can you repeat the proposition? I don't recall anything like this. This is a proposal for...
That on the back of being so helpful to Northern Rock, because you've said yourself, Governor, one of the things that is going to be a problem, if the negotiations went well and you were prepared to think there was an offer acceptable, the shareholders are going to have a say.
Indeed.
And I think the proposition is that at the time you were putting the money in and there was disarray and panic, etc., you had leverage to say to the shareholders, we want a private sector, an immediate private sale. That's the exact words.
Well, there was no proposition like that on the table, and my understanding and our legal advice was that it would not have been possible, because whatever accelerated deal one tries to bring about, the shareholders must be given proper time to consider a bid, and others must be given a chance to make their counter bid.
Okay.
So there was no advice at all to do that.
Now, can I ask your deputy, because he's been getting a rough press really, and this is an opportunity. Do you think you have operated well, the link between the FSA and yourself in the area you're in? Has it worked well, or have there been deficiencies, and have you contributed to the deficiencies?
I think the links between the bank and the FSA have worked well in terms of exchange of information and communication. They don't just depend on me. I'm on the board of the FSA. Callum McCarthy's on our board. But we have put in place daily calls about market development. The FSA are represented on my financial stability board. And I think those did ensure that we shared the information we had and we discussed the issues. Doesn't mean we always agreed, of course.
Okay.
Okay, thanks very much. We've got Peter now.
A central ingredient of our present difficulties is securitisation, the bank's habit of originating and distributing loans and other assets. And in your October financial stability report, you stated that this model has been shown to have significant flaws. Would you calibrate those for us?
Well, let me make a brief comment and then ask John, because he's in charge of the financial stability report. The securitisation model, I think, will return, but not in the way in which it has been operating in the last few years, in which an enormous superstructure of derivative instruments has been built on top of securitised assets, so that the whole complex structure of CDOs and so on, and CDOs of CDOs, I suspect there may be less demand for it. I think they will still exist for those people who genuinely believe they really understand the instruments, and there are those in specialised financial institutions who do that, but I rather think that pension funds and others may come to recognise that securitisation is fine, but just follow the basic maxim, only invest in what you understand. John?
Well, I think that the key thing that this episode has shown up is that some unintended incentives were set up in the originate and distribute model as it applied to credit products. So you found the originators of mortgages had a strong incentive to go for volume rather than quality, and an awful lot of bad loans were made. I think the rating agencies had an incentive to take on as many ratings for as many products as they could. I think the investors had an incentive, because of the different yields, to not look at the fine print of what those ratings actually offered, and instead just to go on the label. And finally, I think the banks had an incentive to use off-balance sheet vehicles for a lot of their operations. Now, the market will correct some of these, and the role of the authorities will be to step in and see if official actions also necessary to correct those.
Yes. Banks don't trust other financial institutions, and you, Governor, said that part of your role was to, and I quote you, dispel that sense of fear. But is not the problem that fear is justified?
Well, certainly at present it is justified to be cautious about where the losses on many of these complex and opaque instruments will ultimately come to reside. But that's why I think we need a little bit of patience now to get through the period, perhaps the end of February, March, when financial institutions will have had to reveal most of those losses, mark to market, and take whatever resulting steps are necessary to rebuild their balance sheets. And at that point, I would hope that we'll have made a big step forward. But as I said in August, and when I came to see you in September, the most important step that's required here is that the private sector, and it can only be the private sector, needs gradually to restructure and reprice many of those complex instruments which people are now very reluctant to lend against or buy. And that will take time, but the process is slowly beginning. Now, there are risks to the world economy in the meanwhile if it results in a banking system that is reluctant to lend to industry. And it's our job to try and take steps to minimise that. But the resolution of the problems in the financial sector will hinge on the restructuring and repricing of instruments and the revelation of losses and the rebuilding of balance sheets. At that point, and at that point only, will you see interbank spreads, these LIBOR spreads, return to normal levels. And it's very instructive that whatever view you take on how central banks have conducted their money market operations, there may be room for disagreement, but whatever central banks did, these 3-month LIBOR spreads are absolutely identical now in the euro area, sterling and dollar. And that tells you that it doesn't have a lot to do with the provision of liquidity and money market operations. It has a great deal to do with the factors that you mentioned.
Yes, your weapon available to you, of course, is credit, and it's rather like pushing on a piece of string. Whereas what we need is someone to sort out the rotten apples.
Well, I think
that power's been taken away
yes,
from
and that will gradually happen. And I think the regulators And the banks themselves have a very strong incentive to see this happen. But it does require auditors to go through a careful process of working out and validating the valuations which banks themselves put on their assets. And this will gradually happen over the next few months.
Can I just add one point there? I think the fear consists of two things. One is that we don't know yet what the price is of what has already happened, the subprime crisis, and if you like, where do the losses lie, will it require recapitalisation? But there's also a fear about the future of the economy, particularly in the US, and the possibility that if that goes into recession, there will be a further round of loans. And I think that part of the central bank's job is to provide some confidence that the economy will be managed in a responsive way going forward. We may not be able to do much about the subprime losses, which is in a sense still being worked out in the past.
No doubt the situation will shake down, but should there be a role for leadership here, and who should take it?
Well, central banks have discussed this a great deal among themselves, and I think the conclusion we've all reached is that actually the resolution of the repricing of instruments is something which has to be conducted in the private sector. And the accounting bodies and the regulators have their important role to play in trying to make sure that the banks, as soon as is feasible, reveal the size of the losses and take steps to rebuild their balance sheets. And you can see that beginning to happen. And I think we just need a little bit of patience to see that process through. Meanwhile, as John says, the challenge facing central banks, and one of the reasons for our coordinated action last week, was to try to ensure that the sense of confidence in how the future policy will be conducted is sufficient not to add this further fear that there will be a layer of extra losses coming down the road.
Good. Thank you.
Okay, Colin and then Nick.
Governor, just teasing out a little bit more of what you just said about these asset-backed securities, is it not now clear that far too many banks were irresponsible in lending vast sums of money against so-called asset-backed securities where they had no idea whatsoever of the underlying value of that asset?
Well, I don't want to make generalisations about what banks did or did not do. I think that what is very clear is that in the United States there was some pretty extraordinary lending in the subprime mortgage market, where people without a great deal of sophistication were encouraged to take on loans that perhaps they could just about afford to buy a home that they never thought they would ever be able to afford. And they were encouraged to think that they could afford it, but only when the policy rate set by the Fed was 1%. And once interest rates got back to a more normal level of 5%, they clearly couldn't afford it.
That might have been the genesis of the problem, but that doesn't absolve the banks, our banks, from lending vast amounts of money against asset-backed securities on which the underlying value they had no idea or ability to calculate.
Well, I think a wide range of purchasers of those assets should ask themselves questions about whether they really did understand what they were buying. But they are accountable to their shareholders, their trustees, whoever. And I think those people will have a lot to say about the decisions that were made to take on board these assets.
Prior to 1997, when the Bank of England was involved with banking supervision, did it monitor bank liquidity as part of that supervisory role?
Well, I think over a long period it's declined, the attention paid to liquidity. It's quite remarkable that in the 1950s and 60s that as much as 30% of the assets of a bank had to be held in liquid assets. That was part of the regulatory regime. Now, of course, the banks weren't widely profitable at that time, because if you have to hold so much of the balance sheet in liquid assets, your chance
much of it was held with you.
Sorry?
Much of it was held with you.
Much of it was indeed held with the bank. Over time, that ratio has declined until it's not much more than about 1% now.
But you did monitor the liquidity.
Well, the bank monitored it, but I think one of the interesting aspects of this is that at the time when the Basel capital regime was being negotiated, the Bank of England did start an initiative to begin a parallel Basel liquidity adequacy regime. And the other, it never got off the ground. Other central banks weren't so enthusiastic. It's a shame, but maybe we need to get back to that.
Yeah. So, John, just briefly, I mean, you're the Deputy Governor with responsibility for financial stability, and you're a member of the FSA board. Why are you still in the job?
Oh, because it's still an important job to do, and I've been appointed for 5 years.
And you think you've discharged that particular responsibility satisfactorily, bearing in mind the state we're currently in?
Yes, well, obviously there are lots of lessons to learn from the last 6 months, but I do think I've done a reasonable job, yes.
Thank you, Chairman.
I mean, we had one chief executive of an investment bank in here that couldn't even make a stab at what a CDO squared was. You know, now the issue here is complexity of these products, isn't it? A tiny number of people knew them, but maybe they didn't even know them at the end of the day, what it was and how explosive a cocktail this was. This is the issue here. It's the understanding of it and also the ownership aspect, where the risk was diversified. These are the real core issues, are they not?
They are, but there is an element of, I call it the search for yield. I think Alan Greenspan would call it human nature. Others might call it greed. But imagine, you know, imagine two neighbours on a Saturday afternoon talking over the fence, and one says, you know, I've got some terrific investment advisor. He's told me to buy these things called CDOs. I've got no idea what they are, but you should see how much money they make. And the other one says, well, I'll have some of that then. Once you see instruments that produce profit, people will invest in it until the point when they realise that it's turned into losses. It's sad, it's unfortunate, but this is an aspect of investment that appears to have recurred for as long as investment has been recorded in human history.
Yeah, but surely there has to be some uplands in the future. We've got to change this system.
Well, what we have to do is two things, I think. One is to put in place a system that, as far as possible, is designed to help us deal with a failing bank, because banks are different from ordinary companies. And secondly, we have to work harder to try to draw people's attention to the complexity of some of these assets and to make them think twice. I mean, when I spoke at the Mansion House in June, I could not have been clearer. You know, I said, are we really cleverer than the financiers of the past? Well, the answer to that is pretty obvious now. But trying to get people to think about that is not easy. One of the tasks that John and I have in the next few months is to try to work out a way in which we can ensure that when we write our financial stability reports and give warnings, we don't just put it out into the ether. Exactly. We try to find a mechanism by which people have to respond, and they visibly have to respond. And I don't have any simple answers to that, but I do think it's a challenge for us. It's one of the lessons, and we have to do something about it.
We've given that some attention in the past, Governor. Nick?
Governor, following on from Peter Viggers and Colin Breed's questions, what started, as you and Sir John have described, as mis-selling of mortgages in Chicago or Washington, D.C., ends up with global financial turmoil, a run on a British bank for the first time ever in 140 years, and nearly 6,000 people in the northeast of England facing redundancy. The conduit for that virus has been the originate and distribute model. Is there something fundamentally wrong with the model, or is it, as you describe in your October report, that there are significant flaws in it, which you indicated earlier could be addressed by the rating agency, of whom around this table nobody's got any confidence in getting their act together, or the auditors, and again around this table I don't think we've got a great deal of confidence in them. So if it's so difficult to get to the bottom of the risk involved in these complex financial instruments, these CDOs, why don't we actually try and indicate that they shouldn't be used at all, and we won't end up in the position that we're in now?
Well, I want to try and distinguish between the financial turmoil that we have now on the one hand and the fate of Northern Rock on the other, because they are separate. I think the turmoil created the conditions in which Northern Rock met its fate, but it was not inevitable, had we had a well-designed system for dealing with failing banks, that it would have resulted in what actually happened. So we can deal with that. Even if there is future financial turmoil, we can put in place, as the Chairman said earlier, a system for dealing with failing banks. In terms of the originate and distribute model, I think is actually been helpful in many respects, and the plain vanilla sale of securitized mortgages has been a very healthy development, and it has in fact enabled a number of smaller financial institutions to obtain funding from others by borrowing against the securitized form of mortgages, and that's been helpful. Where it's become much more problematic is the almost certainly excitement, possibly even hubris, of parts of the financial system in thinking that they could devise and invent instruments of ever-growing complexity and at the same time assume that the market in those instruments would always be deep and liquid. It's almost a contradiction in terms that if you invent an instrument that only a handful of people understand, it may demonstrate the kind of abilities that win you a Nobel Prize, but if it isn't sufficiently understood by enough people, you can't expect the market to be deep and liquid. And what we have to try to do is to make sure that people responsible for investment decisions, whether it's pension fund managers or others, just say to themselves, I am not going to be seduced into investing in something I don't understand, even if I get criticised by people for not earning a high enough rate of return as the next man last year. One of the difficulties here is this immense pressure on short-termism to demonstrate, even as a fund manager, that you have to, each quarter, to have above average returns. I mean, this is a collective madness, the idea that everyone can have above average returns. Mm-hmm. And that's the sort of psychology that needs to be changed. Not that we need to ban certain instruments. I don't think that will help. It's the underlying motivation behind it. What led people to buy things that they didn't understand? That's the problem we have to address.
Yeah, okay, and yes, it is a problem we have to address. How are we going to address it?
Well, I have no simple answers. We, on our part, have the responsibility for trying to think much more deeply about how we can get our message about the risks in the financial system across to a wider range of people, and to make sure that the financial institutions respond and acknowledge in public that they have seen our warnings and understand them, so they can't use alibis later on. But in the end, it does come down to human motivation, that if they think that something they don't really understand may nevertheless give them a higher profit, they'll go for it.
Well, if that's the problem, then it's going to continue, isn't it? Unless there is clear regulation to prevent it happening, to actually to change human behaviour or banking behaviour.
I don't think you can regulate.
But surely the problem is we already had a situation because of the business model of Northern Rock that was far riskier than other models, but nothing was done about it.
Well, that's where liquidity regulation would help, because if we'd had a system of proper liquidity regulation, although Northern Rock would have shown up as doing very well on the capital side, it would have looked very flawed on the liquidity side, and that would have been picked up. And the FSA recognised that, and that's why they're proposing their discussion paper, so they can improve the system of liquidity regulation. That's the lesson from Northern Rock.
Okay, but in terms of the lessons that can be learnt about the originate and distribute model, right, and the CDOs, would you propose regulation to prevent what you describe as human or banking nature, if you like, the requirement within certain financial institutions to take unnecessary risk to achieve high returns?
I would not be in favour of regulation to prevent people devising and selling instruments if they wanted to do so. What I believe is that after this episode, the demand for such instruments, the very complex and opaque ones, will fall radically. What's much more important is that 15 years from now, we publish in our financial stability report a reminder that 15 years ago, this is what happened, because there are cycles in this. You see crises, people learn the lessons, and then gradually they forget them.
Well, exactly. I mean, surely the problem would be in 15 years' time if you actually publish in your financial stability report that we told you so and it's happened again. Well, isn't that the risk by not taking regulation to try and address the problem?
Well, I think clearly we need an adequate system of regulation of banks, but I think a combination of the existing capital regulation and a new regime for liquidity regulation would be sufficient, provided that we also had in place an ability to have a special resolution regime for banks, so that when they did get in trouble, then it didn't have adverse consequences for the depositors.
But aren't you just that way of dealing with it is just dealing with the symptom rather than the real cause?
But I think the real cause does lie, in essence, in human nature and the wish to try to get high returns, because my only belief in this, and I think experience bears it out, is that if you try to pass some detailed regulation saying a particular kind of security cannot be sold to certain people, then there are very clever people out there who will just devise a new kind of instrument that hasn't yet been prevented from being sold to others, and people will get round it that way. What we do need is clearly a sense of responsibility. There's a cultural change, I think, in getting away from this extraordinarily short-term focus on returns in the financial world. But also people who buy these instruments, whether they are pension fund managers or people who hold positions in banks, need to recognise that they should be held accountable for making decisions about what assets they choose to hold. And it doesn't make sense to go out and buy a whole lot of clever things that you don't understand just because somebody whom you've hired as a fund manager tells you that's what you should do. It's the latest thing.
But that's exactly what they did.
That's what some of them did.
Can I just add a couple of points? Firstly, the investors in these cases were professional investors and included actually the banks themselves, many of whose losses came from retaining tranches of the securities that they themselves had helped promote. Yeah. And I think the second point is that if addressing this has to be done on an international basis, because these are international instruments, and so we are working through Basel, where the Director of Financial Stability in the bank is leading the work on liquidity, and in the FSF, where I and Callum McCarthy are involved, to try and get an international policy consensus on how to address these issues.
Okay, but another method to add to Nick's point is training for people in banks, so the proper training, Governor. I mean, to take an example of Northern Rock, neither the Chief Executive or the Chairman had a financial qualification.
Well, I don't want to comment on that. What I would say about Northern Rock is, and this is the tragedy of Northern Rock really, is that most of the staff who worked in Northern Rock on the lending side, all the evidence shows that they did an excellent job in appraising the loans that they were making, and that they monitored very carefully, and they didn't lend money to people who shouldn't be borrowing from them. The lending side was handled extremely well. It was the borrowing side, it was the business strategy that was fatally flawed in this episode, where once those markets had closed in mortgage-backed securities, then they were absolutely unable to finance their wholly illiquid assets as they have become.
Okay, that's an eloquent answer for us. Thank you very much. Sally.
Thank you. I wanted to ask about credit rating agency, but first, just very quickly, Governor, what you've basically said this morning is that there's uncertainty still about the possible scale and distribution of losses, that there's some work taking place to bottom these out, although it's not clear whether people know where the risks are and they're just not saying, and that we won't really know until next March or April, once the banks start to rebuild their balance sheets, exactly where all the risks have been and what the losses will be. Now that will be, 7-8 months after the start of the crisis. And do you really think it's adequate to watch this unfold with the possible risk of another Northern Rock disaster?
Well, I think the problems we're facing are international in nature, as John has said.
Yeah.
The problem of Northern Rock is a UK problem, because we don't have an adequate framework for dealing with failing banks. But to solve the international problems will require a process. We said at the very beginning that it will be a lengthy process by which all these complex instruments will have to be restructured and repriced in order for the auditors and accountants to be able to calculate what the true position of each financial institution is. Now, we have certainly encouraged them, and the IMF have encouraged them, to move as quickly as possible in this process. It is not easy, because when markets are open and deep and liquid, then marking to market, as is the current convention for establishing losses, makes a great deal of sense and can be done without an enormous degree of exceptional effort. But once those markets have closed, it then becomes extraordinarily difficult to know at what prices you should value some of those instruments. And that's exactly the difficulty that some of the banks have had. And it's quite possible that if the auditors are insisting on using, say, a fire sale price used by another bank to value the assets, that many of the losses that are currently going to be revealed will be marked up again to profits next year as some of those prices recover a bit. Yeah. This is a tricky and difficult process. It does need to be gone through, but it's been a very salutary lesson, because this crisis has become international in nature. It is not a crisis of emerging market economies or failed macroeconomic policies in the rest of the world. This crisis goes right to the heart of the financial centres of the three big developed parts of the world. And that has been, I think, a salutary lesson. I think many of those lessons will be learned. But what we have to do now, I think, is to encourage the banks to go through this process of revealing the losses and then recapitalising the balance sheet.
Can we just go on to the credit ratings agencies? Because in the Financial Stability Report, there are a number of recommendations made for reform of these, including widening the scoring systems to include different factors. Do you think that this might ironically have the unintended consequence of actually making some of the investors more dependent on the credit ratings agencies because they will look to them for a wider range of assessments?
Well, rating agencies is a very important issue for everyone to confront. It's being discussed internationally in the Financial Stability Forum, and John is the representative of the bank in the Financial Stability Forum, so I think John should take this.
On the 5 suggestions, I mean, the final one, should they give some view on market risk? I think when Hector Sands came here, he said, well, it depends on whether they can do it sensibly and in an understandable form. And I agree, you know, if it's going to confuse people further, then they shouldn't do it. But I think it is quite important for the functioning of capital markets that the rating agencies do re-establish their credibility. Because it is a collective good, if you like, to the players in the capital markets that they are able to rely on an independent body to give some assessment of credit quality.
Yeah, but they're not. I mean, they're not actually independent, which is one of the basic problems. And the second thing, and I wonder if you could comment on that. And the second thing is that there's a little sort of caveat at the end, and I think it's from your report, saying that it is still critical, however, that investors carry out their own due diligence, which is like a health warning, which is an astonishing throwaway line. How do you propose to get people to improve the due diligence?
Well, I don't think we first of all, we don't have to sort of make them do it. In the sense, investors all around the world are currently thinking they put too much weight on the rating agencies and are trying to either restrict their investment range to the products they understand well, or to increase their own work on where to put their money. So I think that that's a market development.
And how about the independence factor?
I mean, I think the independence. I think the fact that the rating agencies are paid by the issuer is a problem, and did encourage the rating agencies to expand their business into structured credit as far as they could, and perhaps beyond, where their models could really support the rating. I welcome it if investors themselves could sponsor a rating agency which was dependent on investors, and in other words, they were being paid by the people they were supplying the service to. That hasn't proved possible as a business model, but I wouldn't be surprised if some of the investment bodies consider that again.
How are you going to carry these proposals forward? And I would just come back to you, Governor, that you said this was an international problem and needed international solutions, but I mean, we are supposed to be the world leaders in financial services, and it surely really isn't adequate to say, it's an international problem and we're just, little UK here doing our own thing. Surely we should be having a major influence in the international arena, and in particular in dealing with the problems of the ratings agencies.
No, that's absolutely right, and we are. And there's no doubt that a lot of the material that goes to the Financial Stability Forum comes from the work of the Federal Reserve and ourselves. We are the two main financial centres that people look to when wanting advice in these areas. And we are making a big input into it. But as John says, trying to find a purely domestic solution won't work. These are international ratings of internationally traded instruments. So we have to take our partners with us. But there will need to be, I think, a reappraisal of all this. And not least is the fact that the Basel system of capital regulation that is about to be introduced more widely across the world does itself rely on ratings. provided by ratings agencies. And that's an issue that I'm sure people want to look at again.
I mean, just on what could be done. The main rating agencies are approved by regulators, by the FSA and the SEC, so that their ratings can be used in regulation. And one possibility, which I know we're examining, is whether we build on that certain new requirements. There's a code at present, but you could build on that, for example, in the areas that we've suggested. So that would be a form in which the public authorities could influence what happens.
Philip, and then George has got a supplementary.
Thank you, Chairman. Just before coming on to looking to the future, I'd like to ask a couple of quick questions about what's happened today. Can you confirm what the Bank of England's exposure is to Northern Rock today?
I'm not going to give a number today because I don't think the central bank, in its role as lender of last resort, should be giving a sort of public commentary minute by minute on the scale of any facilities. What we have said is that if it would help the company itself to reveal the scale of the borrowing, then it's free to do so. And 10 days ago it did reveal that the facility was at that point £25 billion.
From the Bank of England?
Yes. Well, in two facilities. It's very important to distinguish between two facilities. The first facility was the original Bank of England lender of last resort facility. That is securitised against collateral that is in our possession. We have that in our accounts. The second facility, introduced in October, is the facility from the government through the Bank of England to Northern Rock with an indemnity from the government, and that's entirely at the risk of the government, and therefore they determine what happens to it.
Thank you for making that clear. And the government today has announced that they've increased their guarantee arrangements to cover, it appears, all liabilities of Northern Rock. Could you just comment on that, and in particular the scale of that underwriting and the security package, if there is one underlying it?
Yes. Well, John's been working on this.
Essentially, this does widen the scope of the guarantee to pretty much the whole balance sheet, excluding the capital instruments and the granite securitized instruments. Of course, all that guarantee is secured against the assets of the company. So if there's net asset value in the company, then there is security for all the assets that have been guaranteed.
So you can confirm that this is a Treasury facility, not a Bank of England facility, although it's operated through the Bank of England.
Well,
the risk falls on the Treasury rather than the bank.
The guarantee, it does, yes. The guarantee is a Treasury guarantee, and it goes wider than the 25 billion facility that advance that we've actually made. It covers also all the retail deposits and now nearly all the wholesale deposits as well.
Indeed. And does it also cover the investments which Northern Rock has in other market-traded securities, so instruments issued by other issuers, whether tradable or untraded?
It doesn't cover the asset value of their assets. It covers their liabilities under some swap and other transactions.
I'm looking at the balance sheet at 31st December 06, and obviously there are more recent balance sheets available to you, I assume. There is some 6 billion of debt securities in issue, covered bonds, those are bonds which have been issued by others, which have been acquired by Northern Rock. Is that right?
I'm sorry, I haven't got that in front of me. Northern Rock itself has issued covered bonds, and part of the announcement today was to cover the liability that may arise if the obligations exceed the proceeds of the realised collateral on those covered bonds. Northern Rock also has a treasury which holds some securities, interest-bearing securities, and it made a statement, I think, last week about the nature of those securities.
Of the total balance sheet, approximately 40% is in granite. About a third is now covered by the extended guarantee. Now, about a quarter is the contribution of the Treasury and the bank through their loans to Northern Rock, leaving a very small residual for the basic capital of the bank itself.
Right. So what you're telling us is that roughly half of the balance sheet at the moment is guaranteed by the government in one form or another, roughly £50 billion.
As John said, I mean, if you take out the basic capital of the bank, subordinated debt, equity and so on, then, and take out granite, put those two things to one side, then most of the rest of it is effectively covered by the guarantee.
Right. And that would also include Northern Rock's sellers' shares, it's known, within granite, so approximately £7 billion of the effectively Northern Rock's equity in granite is now also subject to the guarantee.
Well, that's an asset, not a liability, so this only covers liabilities.
Indeed, but in relation to the collateral package that the bank has, if that collateral were to fail, the guarantee would be called.
Well, there are two kinds of collateral here. On the original Bank of England facility, there is name-specific collateral, which is already in our possession, in our accounts, in Euroclear and so on. That's already legally in our possession. There's a margin over the extent of the loan, so that we have a clear margin above the value of the loan. And then the second facility is basically covered by a floating charge on all the assets of Northern Rock, the whole lot, right down to the paperclip.
Right. Indeed. So the Bank of England has quite properly got the best security, and the government has got the least.
Well, I do like to think that we are seen together in the public sector as a consolidated balance sheet, but it does mean that it's appropriate for the Treasury to take the decisions on what's happening to Northern Rock, because they're the ones bearing the risk.
Indeed. And that risk would appear to have increased significantly with this additional undertaking given today.
I think this was a natural extension to help the company. I mean, what's important now is to try to make sure that we can stabilise the company and as soon as possible find a new management team and organisation to take it forward. And I think that's really the next step.
Indeed, but if the bank is only solvent as a result of the guarantee facilities which you put in place, and if any of the underlying asset values are not realisable at the level at which they're in the bank's balance sheet, then the taxpayer will lose, will they not?
Well, there's a margin of capital, as Mervyn was saying. So, but yes, no lending's without risk, and if the assets prove to be worth less than they're currently valued at, yes, that's the risk.
Indeed, in a falling housing market and in a market where it's difficult to determine the underlying value of some of these securities which are sitting on the bank's balance sheet, that would look increasingly likely.
To be clear, Northern Rock's assets are nearly all prime mortgages in the UK, and of course, you can have defaults on prime mortgages, but Northern Rock wasn't itself in the business of creating sophisticated products.
Could I just take you back, Governor, to your answer to the first of Mr. Moody's questions in relation to the history of the Northern Rock the way it unfolded. I think you were very clear in saying that there was no firm proposal on the table when you were asked to whether the bank would guarantee a bidder's funding arrangement. Would you, as the Bank of England, have seen any the detail of the negotiations that were taking place between Northern Rock and any of the bidding vehicles?
Sorry, which this is between Northern Rock and the bidders in the recent...
In September, before the lender of last resort. I'm
Before
specifically referring to Lloyd's TSB's approach.
No, at that stage, any discussions between Northern Rock and any other potential bidder would come out of the heading of private sector solutions and with the responsibility of FSA.
Indeed. So you wouldn't necessarily have known whether there was a firm proposal available. You were being asked specifically whether you would provide a facility, and you wouldn't necessarily have been privy to all of the detailed negotiations that were going on between the private bidder and Northern Rock.
No, but I would have thought that if there had been a firm bid on the table, we'd have been informed of it, and we weren't.
Well, you were informed, were you not? You've told us, I think, today, you were invited to provide a facility in the context of a bid.
In the context of a possibility of a bid, but it was not suggested that there was a firm bid on the table.
No, but indeed, it was the bid could only have been firm had you provided the facility, and therefore for you to say that there was no firm bid on the proposal is surely circular.
No, I don't think that's right. I mean, we were quite explicitly told that it was not the case, that there was a clear bid which was there in every detail but could proceed only if the money was made available. That was clearly not the situation. The situation was the other way round, that the bidder did not want to come up with a firm bid or get into excessive detail until it knew that such a facility would be available. That was what we were told.
And was it the case that you were that precise confirmation from the Bank of England was in limbo, if you like, over the week until leading up to the date on which you decided that would not be provided?
No.
And therefore, that the bidders were being encouraged to continue their discussions in the hope and expectation that you might come through with that confirmation?
Well, it certainly wasn't my understanding. I mean, when I spoke to the Chancellor, well, there was communication between my office and his. He also shared my view, and it was my advice, that it would be most peculiar for either the bank or the government to make a 30 billion loan to a going company to buy another one, when that would have to be made public long before you could actually be sure the bid was going to go ahead. And that, I think the bid was then withdrawn. I mean, it wasn't withdrawn, it just never materialised.
Thank you. You've made that clear. I need to move on because I'm short of time.
Well, last question, Philip, because we've been looking, George.
Okay, Chairman. Do you believe that it's important for the confidence of the financial system in this country that central bankers serve their full term?
I have no idea. In general, I think central bankers should be appointed and serve whatever part of that term they wish to see through.
If you were offered a second term, would you expect to serve it in full if your health allowed?
Depressing thought. That is something we'll return to after Christmas.
Good Christmas.
Thank you very much.
Okay. Is it okay, Philip?
I have some other questions, but if I have time.
I'm really pressing the rule.
Can I, very quickly, a quick question in relation to your statement today and the operation of monetary policy. Is it your expectation that the concerted action by the Bank of England and the other central banks, which was announced last week and is being implemented today, effectively marks a new direction for monetary policy and recognises that the difficulty of affecting spreads, which we talked about when we last met, through reductions in short-term interest rates?
Well, it's hard to say whether it will turn out to be an important step. I do think what was valuable was a demonstration that the central banks were all facing the same problem and recognised that there was no easy way through. And indeed, the difficulty we face is that even the operations we have put in place cannot be guaranteed and are indeed unlikely to bring about a significant reduction in spreads, except insofar as the operation can improve the confidence of the banking sector in believing that the central banks acting together will try to ensure that there isn't a serious downturn in the world economy, and hence that they should be less concerned about the capital position of other banks than they might have been in recent weeks.
George.
Governor, in your October financial stability report, you were commenting on the business model of banks and you projected 3 scenarios. Which scenario would you prefer the banks to adopt?
Sorry, the scenarios in the...
Right. Well, one of them is redesign the security so they're transparent and keep in that business. Second one, which I cannot believe you'd accept, is regard the present situation as a temporary setback and carry on as before once the markets settle. And the last one is settle back and go towards a more traditional model of banking.
Well, I certainly don't accept the second one because I think it's very unlikely that we'll come back to that. I do think that the originate and distribute model has real value, and I wouldn't want to see it disappear. Indeed, in some ways, what happened was that it wasn't a proper originate and distribute model because many of the assets didn't actually fully disappear off banks' balance sheets. They were still kept on through the link through conduits which had to be supplied with liquidity facilities and the special investment vehicles. So I would like to see perhaps a mixture of the return to a more traditional banking operation there's a real place for securitisation. But I do think what is most important is that we need to recognise that banks can be rather dangerous institutions at times. They have extraordinarily highly levered balance sheets, and a mixture of appropriate regulation and careful management of their liquidity position by banks is a sine qua non of any healthy financial system. But in reserve, we must put in place those three changes that I mentioned in my opening statement, because I think they are fundamental to having a banking system where we can have confidence that if problems arise, we have a method of dealing with them.
If problems arise, that takes to Mr. Ainger's questions. I mean, as governor, if you have a desired model, do you see yourself as having a proactive part in ensuring that the financial institutions adopt that model, or is it you're just here to clear up the mess? Yeah.
Well, I think the governor does have a role in speaking out, as I did in the Mansion House in June. But I have to give some serious thought now as to how far we can ensure that our general views and comments are really taken on board. I do believe the experience of the last few months has been a chastening one for not just London, but for all the major financial centres in the industrialised world, and they will learn lessons. Our task, I think, as an institution that will be here long after any of us are around, is to make sure that institutionally we keep coming back to remind people that these risks and problems can occur.
But do you think your only weapon is making a speech? I don't mean decrying making a speech, but are you no more? Can you not be more proactive than that?
Well, if we have no other policy instruments.
Using your influence.
In the end, influence comes down to, I think, to making an argument which convinces people. I mean, our task is not to tell people what to do. FSA is the regulator. If by giving speeches which are sufficiently compelling, and through the Financial Stability Report and the work of John's team, if we can convince people that what they were doing was to take risks that they didn't fully understand, then maybe we'll bring about some improvement. But I do feel that in the last few years we've seen a certain degree of hubris, and it's never easy to persuade people suffering from that to think deeply about risk. Alan Greenspan was not very successful in getting across the idea of irrational exuberance. We have to keep plugging away and trying. But I think trying to win the argument is our main weapon.
I think he got out in time, though, didn't he?
Sorry?
I think he got out in time.
Can I just mention three ways in which I think we can have influence? Because I think the FSR, which I'm responsible for, is a good analysis, widely recognised as such, but we can probably do more in the market. For example, talking to analysts and so on who themselves comment on banks to try and ensure that they're aware of our view of the vulnerabilities. We can do and are doing a lot in the international policy arena. So it's through Basel and the FSF, as I've spoken about, to change international policy. And possibly we can consider whether we can take this analysis down a level, because we've been deliberately careful under the MOU not to get involved in assessing individual institutions, because that's been the FSA's job. But there's a question about whether it would be helpful for us to go a little bit further in drawing out the lessons for particular institutions, and whether that would help the FSA in their task of identifying vulnerabilities.
Fine. Jim, and then Mark finish.
Governor, you told us this morning that you think this is a crisis at the heart of our main financial centres, and we have seen in the last week or two coordinated action by a group of central banks to put cash support into the banking system. Why did it take other central bankers to force you to give up the principle of the penalty rate?
Well, it didn't, and we haven't given it up, in the sense that the auction this morning that was conducted did produce an effective penalty rate of around 60 basis points in terms of the interest rate which people obtain money against this wider collateral. So the mechanism for doing it did in fact produce exactly that. But the nature of the problem in the last 4 to 5 weeks has changed quite markedly. And when that changes, then we too will change. When I sent my document to you in September, before coming on September the 20th, I made very clear in it that the judgments we were making about the nature of operations are ones that we looked at almost daily. And in the last 4 to 5 weeks, there has been a palpable sense of, I use the word fear, in financial markets about the capital position of banks. And that was a point where I think all of us in central banks decided that collectively we needed to take action. That had not been done before. No central bank had acted in concert with others in August or September. There appeared no need to. But now there was a collective feeling that we ought to do that together, and we have.
Do you think more action by central banks or other international financial agencies will be required? This isn't the end.
It's not the end, and I don't know. I don't think the provision of liquidity in this form is the be-all and end-all. It's not a simple answer, and I very much doubt that of itself it will lead to a significant reduction in these spreads in the interbank market. But I think the demonstration that central banks are working together is important.
Governor, I must put this to you. Do you not think that your colleagues in central banks will start to have worries about our central bank because of its communication failures and because of its leaks with which it's become associated?
Well, I don't think it has become associated with leaks, and I don't think there are communication failures. I've said to you that I wish I had spoken out in August. I felt that there were enough people speaking in August that it didn't need more, but I wish I had spoken out in August. What we have been trying to do is to clarify how these money market operations work, and they do not work by injecting extra liquidity into the system. They work by substituting one maturity for another, or in some cases using different ranges of collateral. But it is not a case of injecting additional liquidity. We are the only central bank that has injected a significant extra amount of liquidity.
Governor, you told Radio 4, and I quote, "It became evident that many of the funders of British banks around the world were no longer willing to fund British banks." Do you not acknowledge that your own performance and your own judgments are now a market factor which is affecting us all?
No, I don't accept that. I certainly accept that the failure of Northern Rock has led to difficulties for the British banking system. As I've explained, I think the real cause of that was the fact that it entered August the 9th with a very weak liquidity position, and that after August the 9th, the authorities together had no effective tools with which to deal with a bank in that position. That's why the changes, I think, are so necessary in the longer run. Those were the causes.
Sir John, you've heard all the discussion about the nationalisation of Northern Rock, and you have a considerable knowledge yourself of Northern Rock. How easy would Northern Rock be to denationalise?
Well, as you know, Plan A is to complete the Virgin or Oliphant approaches. Plan B, if we're forced down the road of nationalisation, I'm sure, it would clearly be, as Mervyn said, as a temporary measure to then relaunch it in some form. I don't know that it would be easy or not. I mean, at the moment we're concentrating on the bids we've got rather than the bids we might get in those circumstances.
Do you think there could be a problem of denationalisation?
I'm pretty sure that if the bank was either went through an administration process or was nationalised, it would be possible to pass many of its activities to other institutions in the private sector.
And how many of its employees?
I really couldn't say.
Thank you.
Okay, Mark.
The FSA have defined the role of the Financial Services Compensation Scheme as being not able to deal with all potential failures of financial terms, nor to be a crisis management tool. should it be more comprehensive in its coverage of potential crises in financial services providers?
Well, I think that would depend on where the Special Resolution Regime Authority were to reside. And we look to you for guidance on that, as I said earlier. But what is most important is to recognise that deposit insurance for banks is, in my view, rather different from insurance of other types of savings products and investments. It is not obvious they need to be in the same institution.
But at the moment there's some lack of clarity as to what such a scheme would cover. If it's purely designed for some very small institution of some kind and has no ambition to cover anything very much larger, then that begs the question of where the liability for resolving the future of larger institutions should lie, and if one wants to control the risk of that lying in public hands, how we seek to minimise the risk of that occurring.
Well, I think any such reform to bank deposit insurance ought to cover all banks. That would be the sensible thing. It's a practical matter. It is much harder to resolve problems with big banks than with smaller ones. And that's a question of effort and scale, not a question of principle.
The British Bankers Association, in one of their submissions to us, have said it's self-evident that in this current environment it's difficult to envisage the UK authorities allowing the failure of implicitly any retail deposit taker. Are we in a position where no deposit taker could ever be allowed to fail?
Well, I think if we had a repetition, for example, of a BCCI case where it became clear that a bank was totally and wholly insolvent and there was no possibility of salvaging it, then I think there'd be little point in saving it. But in terms of banks that seem to have a prospective future, as the Chancellor said, the guarantee that was extended to Northern Rock would be available to other banks if they were to find themselves in a similar situation. That's why I think it is important, critically important, to move to a permanent regime of a special resolution regime for banks and a reform of deposit insurance, because that's the exit route from where we are now to go into that new regime.
But if you were setting up something more like the FDIC in the UK, I think it would make sense for that also to do the deposit insurance, and especially if you were having some prepayment of the payments in advance into a deposit insurance fund. So I think the future of the FSCS depends on whether we are doing that.
Because what I'm, and you're conceding this, is the linkage between deposit insurance, which is a way of reassuring a consumer depositor, and the public policy issue of how you ensure that a financial institution continues in being if one takes the view that all but those which are insolvent should remain in being, and then the difficult issue of moral hazard, in which if you have made that public policy commitment that these institutions should continue in being, how you control their behaviour, since they are by implication passing on risk direct to the taxpayer.
Well, that's why it's so important not to rely just on deposit insurance. If you have deposit insurance, there's no point having 90%, because that won't stop a bank run, as we saw. It has to be 100%, but only up to some limit. But in order to prevent banks taking excessive risks on the back of that deposit insurance, the moral hazard, it is much more important to have in place the special resolution regime whereby the authorities can get control of the bank that's been taking too many risks, particularly on the liquidity front. That's why, as John says, the FDIC mechanism does naturally go hand in hand with the deposit insurance for banks, but only for banks.
If you like, that's the trapeze safety net, but there should be some mechanism to ensure that people aren't actually playing the high trapeze.
Well, that's regulation, and this is capital.
Because we've got to find a means of controlling the risk to the public sector. I think most of my constituents would be alarmed to think of the scale of commitments which some of the earlier questioning amplified, that their tax had been guaranteed towards already in this particular crisis, or that we could end up actually owning a bank as an outcome. That would be a considerable surprise to most of my constituents.
Indeed, but that's why I think the only way out of this is to move to a carefully designed special resolution regime for banks and associated deposit insurance. Only once you've got that in place can you get away with taxpayer
and a
concern.
regulatory regime.
Yes, and a regulatory regime.
To reduce the risk to the public purse to a point that people would regard that as a very unlikely eventuality to arise anyway.
The price for having effective implicit support from the public sector is the acceptance of sufficient regulation and, crucially, the ability to intervene in a failing bank before the point of insolvency.
Okay, thanks, Mark. I think Graham has a final question.
Thank you. Just one last question on Northern Rock. Sir John, you used an interesting phrase earlier. You said, if there is net asset value in Northern Rock. What is the bank's assessment of that?
Well, we believe there is a net asset value in Northern Rock, and the default record so far on its loans is pretty good by industry standards. However, there's you can never be certain on these things.
Okay, well, Governor, can I thank you, Sir John, for your evidence this morning. We have had an invite to Christmas drinks at the Bank of England tonight, but you have to take my apologies. I've got a more important agenda item, and it's going to a concert in my local constituency. But I'm sure you'll all keep yourself fit, ready and proper to read our report when it comes out in January.
Well, we look forward to reading it, and we hope you'll be writing eagerly over Christmas.
Thank you very much.
Thank you.
Good.